my Realtist members, my invited guests, ladies and gentlemen across America. Thank you so much for joining in the first ever Web National Association of Real Estate Brokers Web Policy Conference. Today we will learn and teach each other about our different policies of what we'd like to see and what we'd like to have. This is the first time we're conducting this type of a conference, but we're glad that you were able to attend. The National Association of Real Estate Brokers was started 73 years ago in 1947 out of a need for African Americans, Black people, to have their voice heard. Their housing laws were on the table, interest rates, inventory was on the table. And these people, these 11 men and one sister, got together and formed this great organization. I am so very proud to be the 31st president of this organization. And today we will delve into the policies that we would like to see developed and put on the table for the United States of America. At this time, I'd like to open up with prayer offered by my Realtist member. Give us a second as we unmute.
Oh God, Jesus, Derek Jackson.
Hello, this is Derek Jackson. I guess the person that was handled the deal is not available. So if all minds are clear, we're going to look toward the Lord. Dear Lord, thank you for your son, Jesus. Thank you for allowing us to meet here today virtually. Thank you for the National Association of Real Estate Brokers and all its members and sponsors and partners and everyone committed to bringing democracy and housing. We want to pray for this country, pray for this world during this pandemic season we're going through, and we know that it will come to an end when you see fit. All these things we ask in your name of your son, Jesus. Amen.
Amen. Thank you so much, Brother Jackson. I appreciate you. Now, this spring policy conference we do every year to highlight some of the things that are important to our consumers, to our clientele. The National Association of Real Estate Brokers is determined and committed to serving the underserved market, the underserved consumer. So when we decided to put this together, we want you to explore it. We want you to have fun with it. We want you to more so take the information back to your community. This is a time like never before. And in time, your family historian, your church member, your soror, your frat brother, your lodge brother, your neighbor, someone, your grandson, your granddaughter, someone is going to ask you, what did you do in 2020? What did you do when rates were low, but the conditions to get a mortgage were so high? What did you do when Black homeownership was on the table because there's 40.6 or 30% gap in home ownership rate? What did you do? They're going to ask you, did you vote? Did you take part in the census? Did you join a political action group? Did you contribute in what way? How are you going to answer? What did you do? So we're going to go over those things today. We're not going to let you forget it. Answer that question individually, but most of all, be a part of the National Association of Real Estate Brokers. We hope that after this conference, you will decide to join our number. At this time, I'd like to introduce my Public Affairs Chair, Mr. Derek Jackson, the very capable Mr. Derek Jackson, as he moderates this session on Community Reinvestment Act. Mr. Derek Jackson, thank you.
Thank you, Mr. President. As you alluded to, this session is named the Community Reinvestment Act, Your Business, Your Community. And normally when we speak about CRA, it's at a high level, high overview. It's a very policy-driven topic. So sometimes it kind of gets lost in translation what exactly CRA does and what it does for us since it was established. So we want to go over those issues and also go over the reform changes that are happening right now as we speak. So we want to make sure we highlight these areas. And so you understand when we send you that voter voice saying we want to be against whatever changes or for whatever changes for the Office of Currency, or if it's a different regulator, we want you to know exactly what you're standing for. So when you receive those communications, you can act appropriately, sign them, be part of the process, be diligent and vigilant on the steps that we're taking. So without further ado, we do have a esteemed panel, and I would like to begin by introducing each one of them. Our first participant is Mr. Kenneth Kelly. Mr. Kelly serves as chairman and CEO of the First Independent Bank, a minority depository institution based in Detroit, Michigan. He is a respected leader in the banking community, currently serving as chairman of the National Bankers Association. He earned an electrical engineering degree from Auburn University and completed the executive MBA program from Alabama. So we would like to welcome Mr. Kenneth Kelly to the panel.
Thank you.
Our second participant today is Mr. Jesse Van Tol. Mr. Van Tol is Chief Executive Officer of the National Community Investment Coalition. His work in championing fair housing and responsible banking has resulted in $150 billion in new investments in low and moderate income communities through community benefits agreements with 7 banking institutions. He's received his BA in History and International Studies from the University of Wisconsin, Madison, and is part of the NAREB Achieving Excellence cohort at Harvard Kennedy School. Welcome, Mr. Van Tol.
Thanks for having me.
Last but not least, we have Hillary O'Shelton. Hillary O'Shelton presently serves as Senior Vice President for Policy and Advocacy, Director for the NAACP, the Washington Bureau, for over 2 decades in this capacity. Hillary is also responsible for advocating the federal public policy issues agenda of the oldest, largest, and most widely recognized grassroots-based civil rights organization in the United States, to the U.S. government. Hillary holds degrees in political science, communications, and legal studies from Howard University, the University of Missouri, Northeastern University, respectively. Welcome.
Thank you. It's great to be here.
So I would like to start. They have a list of questions here, and this question goes out to all the panel members. How will the modernization of the CRA impact Black home ownership? That's a very broad question. So if each of you can just touch on that subject for me. Start with Mr. Shelton.
Sure. Thank you. Thank you. Well, first, it's great to be here. Thanks for having us. Really appreciate what you're doing, and we're just delighted to be involved. So let me just say first, to make it abundantly clear, the NAACP was and is still very much opposed to CRA modernization. Let me clarify that, as proposed by the Office of the Comptroller of the Currency and FDI and the FDIC, as was adopted yesterday. You mentioned, and you're absolutely correct, new policies are not only being crafted on Capitol Hill, but they're also being interpreted by the various government agencies that have oversight and responsibility. So while the NAACP supports efforts to clarify the types of activities that may qualify for CRA credit and create avenues for banks to get CRA activities pre-approved faster, we do not believe that an expanded list of approved activities with no minimum level of benefit for low and moderate income individuals, communities, and families of color is the best way to assure that banks are addressing the very real needs that CRA was set in place to address in the first place, as in terms of some of our neighborhoods and how they are located. So even before the pandemic, African-American home ownership rates were at approximately the same level that they were before the 1968 Fair Housing Act was passed. And of course, the discrimination is still a major challenge for us. That's just over 40%. With the changes to CRA, we will be experiencing less investment, we believe, into communities of color and less opportunities for borrowers of color to access capital. These two factors, we believe, when taken together, will make it much more difficult for African Americans to buy a home under this new interpretation and implementation of this particular policy. I'll stop there.
Thank you. Mr. Van Tol, any comments?
Yeah, sure. So, first of all, let me thank Antoine Thompson. Thanks, NAREB, for having me here today. Delighted to be a part of this panel and to talk to you today. I agree with my colleague Hillary. There's unfortunately very little that the reform effort proposed by the OCC and then issued in the form of a final rule yesterday will do to help Black homeownership. In fact, I fear that it will make it worse. We have been a long-time advocate for expanding CRA in any number of ways to cover more institutions, to cover mortgage companies, which are not covered, but also to bring race into CRA in a much stronger way. You all probably know the history. CRA was a response to redlining, was a response to discrimination in Black and brown communities, but it was set up on a class basis. It was set up to look at low and moderate income. And race comes into CRA because CRA examiners are required to look at fair lending concerns. They're required to look at the track record of banks making loans to Black borrowers, making loans to Latino borrowers. But in reality, they don't really do that. And in fact, this OCC under the Trump administration has significantly weakened the fair lending concerns that are present within CRA. And so they had the opportunity to strengthen CRA in a number of ways to make it more meaningful in the communities that we work in, to require more of banks. 98% of banks get a passing grade on their CRA exam. And we know that 98% of banks are not doing a good job, certainly not doing a good job of creating Black homeownership. We've seen many banks retreat from critical lending programs like FHA. We've seen banks in this current moment constrict credit and raise credit scores. And CRA could do more to incent those banks to make those loans, could cover mortgage companies who have no obligation under CRA to serve the community, and could have been strengthened in this moment. Instead, what we're seeing from the OCC is a proposal that really makes it easier for banks to fulfill their obligations, expands what counts to include things like infrastructure and roads and high dollar projects that they'll get a lot of credit for, instead of making the small business loan, instead of making the home mortgage loan to Black borrowers, to low and moderate income borrowers. So, we're very concerned about the rule that went forward yesterday. Fortunately, we were successful in getting the FDIC to not join. The Federal Reserve has not joined. Those entities regulate smaller banks mostly, but important that they have not joined on with this harmful effort, and we will continue to fight to overturn it in a variety of ways, and to continue our fight beyond this administration to strengthen the law, to make it more meaningful, to hold banks accountable for not lending to Black borrowers, for not lending in low and moderate income communities.
Thank you for that insight. Mr. Kelly.
Thank you, Mr. Jackson, and Mr. Thompson, and Mr. Williams for having us. On behalf of the National Bankers Association, we're very grateful to participate. I want to thank the 238 participants on this call. I'm going to sum it up by not repeating what my colleagues Hillary and Jesse just stated, but just say just a couple of words. One is that we're seeing in broad daylight the importance of economics, politics, and culture play out right in front of us in broad daylight. So we need the participants on this call to be advocates for what you heard Jesse and also Hillary just mentioned. I will sum it up by saying that CRA had an intent, and I'm not sure that it has equaled the impact. And so as we continue the discussion today, we need to be thinking about how does the intent end up equaling the impact? And I'll end my comments there on that.
Definitely, we're going to expound on that a little bit later about the intent of CRA. But Mr. Van Tol brought up a very interesting question or point. How are so many financial institutions able to get passing CRA report card with such a significant lending disparities in mortgage lending.
Hey, let me jump in on it because it's
Okay.
really the essence of what I just mentioned, intent and impact, right? So the intent was it's an antidote to redlining, as Jesse or maybe Hillary had just stated. But the reality is what we're seeing is lowering of home ownership, in particular in minority communities, specifically to African Americans. Now, let's just use a sports analogy. In everything that we do in America, we measure it by what? The gold medal, the Super Bowl, or the NBA trophy, or the Masters, or whatever that may be, because we rate those who do well by giving them the acknowledgement that they've done well. As Jesse mentioned, over 90% of banks pass. There's only less than 10% actually get outstanding. So that's only 10% saying that they're doing outstanding. The other roughly close to 90% are getting satisfactory. And so what we've done inherently is made it possible for people to kind of get by just getting by. And so as we look at CRA and the modernization of it, we should be demonstrating a desire for the intent to improve the impact by ensuring that those who are getting outstanding get outstanding, and those who are just barely getting by with, say, a D, not get the compliments of getting a B grade. And that's the system that we have in place right now. And so you see them getting by just because there is not enough emphasis put on those actual results. In fact, what we are concerned about, and maybe Jesse just mentioned this a moment ago, is muddying the water on all of these other ways you get credit that doesn't get to the intent. And so I think this body of 245 people now, we have to be very vocal about what we want the outcomes to be, such that the intent will equal impact.
Very well. Mr. Ventol?
Yeah, I can. I completely agree with those points, and I'll say one of the fatal flaws in CRA was that the law, the only enforcement mechanism in the law was really the participation and activism of people. CRA works when people send in comment letters on a bank's performance. It works when people get active on bank mergers. Those are the sort of teeth that CRA has. On its own, left to the regulators, the kind of grading scheme that they've developed, again, as my colleague said, most banks get a satisfactory outstanding. Those are passing grades. It's less than 2% that fail their CRA exam, which has some consequences. And so, we need to strengthen CRA with regards to its enforcement. We need harder grading. We need more meaningful benchmarks and metrics around success. But we also need more people involved. We need more people writing a comment letter to say, hey, listen, this bank is not doing much in my community. And when we have done that, we have seen great success. Those $150 billion that we have done in community benefits agreements came from organizing coalitions of people that approach the banks to say, you're not doing enough. And that's a big number. It may sound like it's not real. A lot of those agreements were double-digit percentage increases in lending to low and moderate income people, to African Americans and Latinos. So, policy-wise, there's some changes we need to make to strengthen the law, but we also need more people to use the law, because that is when it has teeth.
And let me say that you made my job so much easier. I'll speak in DC terms by associating myself with the comments of both my colleagues on this panel. So let me first point out that because of CRA, low and moderate income communities and communities of color have seen some growth in access to sustainable mortgage credit, small business loans, community development, and partnership between financial institutions and communities they serve. Yet it would be possible for one law alone to undo centuries of segregation and bias that has built the financial sectors for a few decades now. So the reality that financial institutions have been able to get passing CRA report is indicative of progress that has been made. There's still significant, however, disparities in access to credit based on race, ethnicity, and a whole host of other attributes that indicates to me that we still have a long way to go, a lot of work to be done. points raised earlier are absolutely right on target as we talk about its strengths and its weaknesses. The data collected is very helpful, and the opportunity to send letters when financial institutions are misbehaving is a great idea. The data-driven guidance, the need to strengthen the rules is more important than relaxing them.
Yes, this is such an important topic, and we are extremely proud to have you three here speaking about this, and it's something that needs to be addressed. And we want our members to be engaged and be knowledgeable about this process and what's going on now in Washington, D.C. I have a third question here. How will the modernization of the CRA protect Black displacement or accelerate it in historically Black census tracts? Mr. Kelly, you want to go first?
You're muted.
You can't hear me? Can you
No,
still
no,
hear
no,
me?
I was muted. Sorry about that. So
Okay.
as you think about that question, you got to think about more of not just one metric, but kind of the ecosystem. And so what we see, and we use these words, gentrification, et cetera, it means moving out code language for certain individuals by race and or by class. And I think we have to look at it more holistically, right? Most communities are sustained by several factors. They're sustained by jobs, they're sustained by education, strong public service, et cetera. And so when we look at just one of those components, whether that's just home lending alone or the bigger construction or just bigger dollars being put into an area, we got to think about what are all those ecosystem components that's going to make it sustainable. And so it is not surprising to me when we look around and we see that some communities go up and some go down, even though the broader metrics may show that we're doing a lot of work. I think we have to be more comprehensive in our thinking about CRA and ensure that it is, again, more holistic to not have those outcomes that you just mentioned.
I definitely agree about that. As I put on my real estate broker hat from my public affairs committee hat, when we see CRA loan programs, especially in the urban areas, such where I'm from, Philadelphia, a lot of those times these products were promoting gentrification by these census tracts. So it was a tool that was being used to promote CRA, but it actually was a weapon against the community because the people that were using these CRA products did not look like the people that we have here today. So can one of you expound on that and just how do we stop that from happening with the current reform?
Sure. So, there's an issue within CRA. CRA was designed, CRA was always about people in place. And there was a recognition that you got to invest in place and in people. I think in making it sort of an either or, you can make a loan in a low and moderate income place to a middle and upper income person. You do see in some places gentrification and activity, where banks are getting CRA credit for making loans to middle and upper income people. That's resulting in displacement. Here in the Washington, D.C. area, we see that. And so we had proposed that as part of CRA modernization, that you actually look at places where you have a significant amount of gentrification, places, neighborhoods, down to the neighborhood level where you do have rising property values, people moving in, and say that's part of the performance context. And a bank shouldn't get CRA credit in that instance. They should get CRA credit for lending to the individual, not just in the place to people who are moving in and displacing people. At the same time, there's big parts of the country where you have no discernible level of gentrification happening at all. In fact, the problem is a lack of any investment. And we don't necessarily want to cut that credit off. So it's I think the OCC made some effort to address this. Initially, they said they were going to not qualify or give credit for any loan to a middle and upper income person in an LMI place. They sort of reversed course on that, and they're giving slightly more credit if the loan is to a low or moderate income person than to a middle or upper income person in a low and moderate income place. That may be somewhat helpful, but more is necessary to really to really control for that and to correct that issue.
You brought up another very good point, and I probably direct this to Mr. Shelton. LMI, low moderate income. Will the CRA reform, or is there some way we can advocate to have that LMI definition adjusted? Because a lot of people, 80% of area median income is still not affordable housing. So how do we address this issue of low to moderate income through CRA?
Well, let me just say, as I mentioned earlier, we can to kind of begin the conversation in this direction. As the NAACP was opposed to the proposed OCC changes to the CRA, and that we felt that they would less investment for our communities throughout the country, and of course, less opportunities for borrowers of credit to have access to capital. African Americans, as we're looking at the decision, begin to talk about how we utilize what we know. African Americans lost our homes in disparately record numbers during the economic downturn of 2008. You may remember those many challenges along those lines. And we are losing our homes and our businesses in this disparately record number as a result of the current pandemic, as looking at the impact again of coronavirus. So before the current pandemic, we were witnessing record inequality between races and ethnicities, and a weakening of the CRA right now can only lead to a, if not a growth in the inequalities and that divisiveness. The bottom line is that the kind of information and data that your members receive as you're selling homes and businesses all over the country becomes extremely helpful. Being able to have that information both for purposes of anecdote. Too often we lump everything together and assume that if you have the data, it speaks to the real issues and challenges and even the repair that needs to be done. So collecting that data as you guys do, having those stories that point out where the breakdown is as you're selling homes and working for people across the country proved to be extremely helpful. And certainly the NAACP, through our economic justice efforts, would love to also have that kind of data to add to the information that we're already utilizing to try to pressure the federal government and the agencies we're speaking of, OCC and otherwise, to recognize our challenges and help us address the changes we need to secure opportunities for our people all over the country.
As we wrap up this part of our session, if Mr. Van Tol and Mr. Kelly can just tell us what impact has COVID had on CRA reform?
Well, you would have thought it'd have a bigger impact. We and many others called on the OCC, called on the FDIC to delay the rulemaking. We're in the midst of a global pandemic. We're all occupied in serving our communities and making sure that that the damage caused by this is mitigated, and to move forward with a rulemaking at this time struck a lot of us as nonsensical. We may have had an impact. The FDIC did not join with the OCC at this time in this rule, and they had joined in proposing the rule, and I think they did hear that given what's going on, now's not the time to move forward with the rulemaking. And I think I think for all of us, the current moment, COVID-19 reveals something we already know, which is inequality is a really big problem in this country. That a great many people are not very economically secure. 2 weeks into a health crisis, 2 weeks into stay-at-home orders, we passed one of the, if not the largest stimulus package in American history. That's fundamentally because people don't have savings, people don't have wealth, and that is driven by some of the kinds of things that CRA can help solve if it were made stronger, if it were a stronger tool to ensure that people can get small business loans and home ownership loans, if it were a stronger tool motivating banks to invest in community. And so, for us, it strengthens our resolve that a strong CRA, a CRA that forces the banks to do more, that gets more mortgage companies in the game on on serving low and moderate income communities, that these things would be helpful to our cause with a stronger CRA.
Thank you. Mr. Kelly, any final thoughts?
Yeah, certainly. Again, let me go back to my reference earlier, and I know I was very succinct on economics, politics, and culture. Right now is a time for advocacy from your organization to speak about these policy issues and how they impact you and the communities that you serve. I believe that the stage and the lights are as bright as they're ever going to be on the hill right now. And this is the time to engage. I had a conversation with a couple of the individuals in the OCC on Monday about what was coming out. We will have continuous conversations on this topic. We're talking to the chairwoman of the FDIC. I sit on her advisory council on CRA. And so my point, though, is for you, the everyday individual that just says, you know what, I'm just minding my own business. This is your time to figure out how to engage. And maybe if it's not you as an individual, maybe it is your chapter through Mr. Thompson and Mr. Williams in being sure that your position on this topic is being heard. I will tell you that people are listening at a high level across the country, in particular in DC, regarding what's going on in these communities now. So if I had to say something regarding COVID's activity is bringing a brighter spotlight into a lot of areas of life. And you see that in the different bills that are being passed. The HEROES bill that I can't remember the number of pages, but it's hundreds of pages. All of the items that are problematic are showing up in some of these bills. And my point is, if there are items you want to advocate for, this is the time to do it. So I'll sum it up again. It's economics, politics, and culture is the way that we need to engage in this effort and ensure that the things that are important to all of us on this call are being heard from you at the ground level, not just from someone as the talking head of the organization. So that would be my advice on COVID and how it relates to, you know, the realtors' effort as it relates directly to home ownership.
I'd like to thank all the panelists for doing a great job in communicating how important this topic is, and for all the work that you do throughout the country and in Washington, D.C. on promoting democracy in housing and equal treatment in everyone. I see our president has rejoined us. We're going to get into some questions from the chat, I believe.
Correct. We're going to call our chairwoman of the board, the National Association of Real Estate Brokers, none other than Madam Michelle Calloway, to answer the chat.
Thank you, Mr. President. Thank you, gentlemen, for your presentation. We have a couple of questions. The first one is, what steps do you recommend for realtors to take when their local financial institutions are not performing and have a low performance in their CRA requirement? That's for anybody.
Sure. I'll jump in. It's Kenneth Kelly again from the National Bankers.
For Section 202, $15 million for 811, and $2.5 million.
Whoever Home Free USA are, you need to go on mute. Can someone mute them? Thank you.
Okay.
I think there is nothing more powerful than to hear from people in the community on this subject matter. And I will tell you, it will get the attention of the CEO very swiftly, depending on the size of the organization or the respective owner of that topic inside of that organization. So it is not uncommon to someone to call, and you don't have to do it as a single individual. You can take a group or a group of people and say, hey, by the way, we want to talk with you about your CRA report card and help us to understand how can you make change. I'll give you a real live example. Even in our bank, I got a call one day to meet a couple of individuals. And I said, absolutely, I'd love to meet them. And they sent me a list of changes that they wanted to see. So they were making a demand of the bank, really. And I had checked off and said, okay, I can do this, or I can do another one or two or three of those things. When I met them, there were a room full of people in the conference room. In fact, they had the whole parking lot, the front part of the parking lot of the bank, they had filled it up. So, but we sat down and talked through the issues, and we made some spot and on the moment changes right there with them because of hearing from them in the community. So I would advocate your engagement if you have a bank branch or someone in that area to help you get over those issues.
This question is for anyone in the panel as well. Just to piggyback on that, how would we find out what type of investments our community banks or banks in our community are doing with regard to CRA. How do we find that out?
I'll jump on that one again. I think it's just real quickly, it's questioning the banks and asking them for, you know, their responses to that. And that, again, is the advocacy that will kind of highlight the issues. Now, some will probably run away from that and not want to answer it. And I'll let Jesse and Hillary maybe give a little bit more. But from a bank's perspective, it, again, is putting the lights on the stage on that topic.
Sure, and you know, on both of those questions, I think, you know, it starts with knowing what a bank is doing, and it's actually, you know, every person's right to have access to a bank's CRA exam. They're in fact required, if you walk into the branch and ask for it, to hand it to you. You can also get it online at ffiec.gov. You can go to my organization's website. We help people find that information. So getting a CRA exam, really reading it, understanding, you know, there's not just I mentioned satisfactory, outstanding. There's also scores for each and every test, for lending, for investment, for services. Banks get a score. They get a score in every assessment area. They get scored on those factors as well. So they may be doing well in one place and not so well in another place, and you can find that out. So understanding what the exam says, understanding the data. You know, we look at Home Mortgage Disclosure Act data, and we look at, okay, how well is this bank doing? That's something, again, you can access. The cfpb.gov has a Home Mortgage Disclosure Act tool. You can look at a bank, you can compare it to other banks, maybe see who in your market is doing the best, who's doing the worst. You know, maybe that one that's doing less well would be a prime candidate to go to and have the kind of meeting that Ken described, to say, listen, we understand, you know, looking at the data, it looks like you're lagging some of the other banks in the market. We want to talk to you about that. Here are our ideas about what kinds of changes to product you could make to make your product maybe a little more attractive to our clients. Here are some ideas about programs and partnerships you could put together. You know, and I think I would emphasize it, you know, it's powerful for one voice to bring that. It's powerful to send a letter to the bank. I think that always gets attention. Powerful to have a meeting. Even more powerful if you do it as a group. As Ken mentioned, you know, if you really assemble more than just you, but really assemble a broad swath of the community to go to a bank and say, listen, you know, it doesn't have to be a hostile thing. It could be, look, we like you, we like this, but maybe this one thing is not going as well. And you know, that could be issues large and small. You know, I mean, I was in a meeting one time and people said, look, it takes forever to close loans with you, so we just don't we just don't do it. Well, that was big news to the CEO of that bank. You know, I mean, that was something they wanted to fix right then and there as fast as they could. They don't want to be the bank that takes forever to close loans. And they didn't really know that, or didn't have that impression of themselves. So these, you know, kind of using it in the CRA context can be very powerful.
And I just agree with both of them very strongly. I do think it's important. I want to put the emphasis on, in the line of work that you guys are in, being able to report challenges and problems is crucial. The whole tool of CRA was created to actually enhance the necessity of banks to listen to those issues and concerns coming from. So in essence, I just want to give an amen to both responses. We strongly agree and believe in that. As a matter of fact, the NAACP has economic development units in our branches across the country, and part of their responsibility is to do just that.
Well, here's a piggyback on that. So with that being said, we have a question from Facebook about is there opportunity for community oversight committees that work within that the banks will be accountable to? Is there anything where these community stakeholders could be involved in, so that there is oversight beyond regulatory oversight? So does that exist, or is that something that should be recommended by the likes of our organization? Because we're talking about how does the community, you know, they're supposed to do these things, but we see that it doesn't always connect. Anybody for that one?
Yeah, I don't know that I would formalize it as so structured. I think the approach hopefully conveyed in my example, and I think Jesse was agreeing to it, is one where you can go and kind of sit down and sit around the table and have the conversation in a way that gets more progress. I think the unintended consequence of it being too structured is you have people not want to show their cards and may not want to engage in a way that could be meaningful going forward. So that would be my recommendation. But my thought to this whole organization would be each of your chapters. And I know I work directly with the chapter there in Detroit with Sister Bartell and many others would be willing to kind of sit down and have these kinds of conversations in a way that can be conductive.
And just to add, I agree. I think that kind of coordination is very helpful. And I think it really depends on the bank you're dealing with as well and their attitude towards that active engagement by community, including community partners like you guys and NAREB. So the coordination between, for instance, talk about Detroit, we have a huge office in Detroit. You may know Reverend Wendell Anthony and his engagement along those lines, but we also work very closely, of course, with the National Urban League and great work on economic development issues as well. And then there are a few of our other friends that focus heavily on these issues that help us all get through this struggle together. The bottom line is we're not trying to put anybody out of business. We're trying to make sure that the businesses that they are able to do the extraordinary job that they can do if there's that kind of coordination.
Well, Hillary, Reverend Anthony is on our board, so I'll be sure to tell him we have a chance to meet.
Please do, please do.
Right.
Great people, great people.
Gentlemen, I want to give one last question, and then I'll turn it back over to the president. So we had a question here about refinancing in gentrified areas and basically the role that we would expect regarding CRA around being able to do refinancing for those who are already in those communities when we see these loans and loan amounts going up substantially because of gentrification. Does CRA have any impact on that, of managing that?
Not really. To an extent. Let me say to an extent. So, one, I think access to credit, access to refinance. If there are people who have trouble getting refinance loans, CRA can have a role in promoting access to make sure that low and moderate income people, African Americans, people have access to good refinance. Lending. So insofar as you can kind of use CRA to advocate for that, it does. And again, I think there are ways CRA could be strengthened to address gentrification. We talked about that earlier, to be a deterrent, against that kind of thing. I will say back to the previous point, some banks do have advisory boards, and I encourage, if you don't know whether your bank does or not, and some of them have it at the national level and at the local level. And, I would encourage people to ask their bank. We're also big fans, we organize community reinvestment coalitions locally and to bring together everybody in a community to talk about bank performance and say, okay, how do we approach the banks together to address some gaps? And sometimes it's not just a gap in a performance at one bank, but sometimes it's a problem everybody got to work together on. And if the banks are not working together, they don't tend to like to do that. There are ways to use CRA to raise and encourage all of the banks to tackle a problem that's a big problem in your community, and using data and research and studies to raise those issues. So we certainly encourage people to form those kinds of coalitions, to start those discussions, to raise those issues. CRA is supposed to be about serving the convenience and needs of the community, addressing community concerns. And so when the community raises a concern, that is a way of helping to define what those issues are and getting banks to address them.
Well, thank you, gentlemen. That concludes our Q&A. I want to say to everyone to check our chat. There are some links that have been put up that you can go to get more information on CRA. So please check into the Q&A. Mr. President, I turn it back over to you. Again, thank you, gentlemen.
Thank you. Thank you so very much, Madam Chair. At this time, it gives me great pleasure to introduce Congresswoman Yvette Clarke. Now, Madam Clarke hails from the People's Republic of Brooklyn. Congresswoman Yvette Diane Clarke serves as the 9th Congressional District of New York, dedicated to continuing the legacy of excellence established by the late Honorable Shirley Chisholm, first Black woman and Caribbean American elected to Congress. Congresswoman Clarke is a graduate of Oberlin College and received the honorary degree from the Doctorate of Law from the University of Technology, Jamaica, and the honorary doctorate of public policy from the University of Commonwealth of Caribbean. So without further ado, Congresswoman, thank you so much for joining myself and my members on this day.
Thank you. Thank you so much for having me, President Donnell Williams. Let me take this opportunity to also thank your Executive Director, Anton Tomlinson, for inviting me to address you here today. Good afternoon, everyone. My name is Yvette Clarke, and I represent the 9th District of New York in the House of Representatives. To be more specific, the People's Republic of Brooklyn. I want to thank NAREB for convening this critical forum on a number of issues immediately impacting people in our communities and hampering the progress of our nation. I'd like to also thank my fellow speakers and panelists today. A shout out to Hillary Shelton, who I know is one of the panelists, and of course my colleague, Congressman Gregory Meeks, for participating and adding their voices and expertise on all of these very important topics. Brooklyn is no stranger to the history and impact of redlining. Many of the neighborhoods in the 9th District of New York were listed as unworthy of private investment or public support. Manuals written and distributed by the FHA made very clear what the federal government thought of my district. Too many Negroes, too many Jews, too many laborers. I'm sure the people here and listening and are likely to have taken the time, who have been likely to take the time to investigate the history of redlining and internalizing the impact that it has had on our nation. But few amongst the public have generally done so. Take a step back and appreciate what these manuals actually say. They're saying that the federal government, the same body that labeled itself as the last line of defense for civil liberties and civil rights, and the primary protector of the downtrodden, said we were not worthy of investment. Instead of risking some level of social upheaval, instead of making hard decisions necessary to live up to our creed of a nation of equals, instead of giving everyone an opportunity to participate in the American dream, the federal government said we were not worthy. Many would like to leave this history in the past, but the lingering effects have been made manifest all around us. And I think they're even more highlighted by what has happened in low to moderate income households as a result of the COVID-19 pandemic. Nearly 3 of 4 formerly redlined neighborhoods are still low to moderate income today, with the 4th all too often having been gentrified. As a result, the wealth gap has ballooned, with white households now holding 10 times the wealth of the average Black household. These financial realities fundamentally alter the opportunity landscape for minorities harmed by redlining. The evidence has become overwhelmingly to suggest that the concentrated poverty in formerly redlined communities entrenches disadvantage, nearly eliminating the possibility of social mobility. Without any substantive wealth, victims of redlining oftentimes must navigate life with nearly no optionality. A lack of wealth makes it difficult to secure loans necessary to start businesses, thereby giving an opening to payday lending and other types of predatory loan schemes. It's made it next to impossible to find a home in a neighborhood with the resources necessary to foster upward mobility. And worst of all, effectively eliminates the possibility of second chances in life. Put plainly, victims of redlining, largely the Black community, already suffering from a long history of marginalization and discrimination, have been forced into veritable second-class citizenship with little opportunity to change their station in life. Make no mistake, our attempts to rectify this history and better distribute opportunity to those who have historically been denied have been insufficient at best and disingenuous in its execution. Despite the best intentions, the Community Reinvestment Act, CRA, fits this description perfectly. Designed with the best of intentions, the execution and enforcement of the law have been lacking, to say the least. The CRA does not provide adequate oversight and allows large financial institutions with a history of unbalanced lending to continue their practices without fear of oversight. If Wells Fargo, the originator of what they call ghetto bonds, that contributed to the housing crisis by industrializing predatory lending practices at the expense of Black communities nationwide, can manage to receive outstanding ratings under the law's parameters, something has gone horribly wrong. The new rule changes lack the support of Chairwoman Waters or the FDIC board for a reason. Expanding the criteria of what investments qualify for CRA credit only incentivize more creative accounting on the part of banks to continue to lend to their preferred clients. If we want to address the history of redlining, we will need to address the issue head on rather than shifting the responsibility to private lenders as if the federal government does not have an equal share of culpability. I introduced a resolution along with over 30 members of Congress to properly delineate the history of redlining. This resolution makes clear that the federal government effectively created a 30-year amortizing mortgage and in turn laid the foundation for an effectively whites-only middle class. If we want to turn the tide, we want to begin to scrub the stains of redlining from our national identity, the federal government must take the lead. So I want to thank everyone for having me share my viewpoint, which I believe is based in the facts and the history of our nation and our communities. And as you move forward, I hope you lean on your expertise to help create a path forward that will actually give victims of redlining the aid they deserve. And I think there's no better time than now. When I think about what we're going through with COVID-19, right now, of course, you know, the House of Representatives has moved into full emergency crisis relief mode, but there's going to be a recovery and rebuilding mode. And if our past is prologue, again, our communities that have been hardest hit by this pandemic will be even more vulnerable to these deceptive practices, to gentrification than ever to mortgage foreclosure crisis than ever before. So we're going to rely on NAREB. We're going to rely on all of the expertise that we have amassed these many years to give guidance to meaningful federal policy. And I will be there to receive your recommendations and make sure that we are taking the best of our knowledge and expertise to craft 21st century legislation and policy that meets the real needs of the people that I represent, that you represent, and that we call our home and our families. With that, Mr. President, I thank you and I yield back.
I thank you so very much. I'm totally on board. Thank you so much for those words. My family here is very excited. Thank you so much. We'll stay in touch. Thank you again.
Thank you.
At this time, Realtist members, it gives me great pleasure to introduce a friend to NAREB, a friend to the Realtist organization, and another congressperson from New York, Congressman Gregory Meeks. From public housing to the nation's capital, Gregory Weldon Meeks has lived a true American dream, a true American success story. He earned a BA from Adelphi University and a Juris Doctorate from Howard University. Known for his compassionate and tenacious representation of his constituents and his coalition building skills, Meeks proudly serves the constituents of New York's 5th Congressional District in the U.S. House of Representatives. He earned a BA from Adelphi University, and he is here with us today, and I'm so proud to call him a friend, Congressman Gregory Meeks.
Thank you so much, my brother. And thank you, and it's always good to be with NAREB. And I wish that we could be together, but unfortunately, because of this pandemic, we've got a new normal, I guess, and the new normal has been this Zoom way of communication and talking to one another. But I want to thank my brother Antoine Thompson for all of the hard work that he has done, both before when he was in the state legislature and clearly now with you at NAREB for what he does and trying to make sure that we're keeping everybody together. And to Brother Donnell Williams, we thank you for all of your hard work and how you are keeping us, you're like the glue to make sure that we're having the dialogue and the conversation that we need to have, because what's at stake is our very future. When you think about the racial home ownership gap, according to the Urban Institute, since 2001, the Black home ownership rate has seen the most dramatic drop of any racial or ethnic group, declining 5% compared with a 1% lose you.
You're there. You're there.
I saw I got muted for some kind of way, but and I don't know how long I was muted. But let me just say this, because I know what happened was probably the Democratic caucus is trying to get to us for a meeting. So I'm gonna do that right after I do address and talk to you quickly. So that phone continues to ring, and that must be what took place. But basically, what I was talking about, I wanted the folks to know about according to the Urban Institute, since 2001, Black home ownership rate has seen the most dramatic drop of any racial or ethnic group. It was declined 5% compared with a 1% decline for white families and increases for Hispanic and other families. The cohort of Black Americans that has lost the most grounds relative to other racial and ethnic groups is middle-aged homeowners from ages 45 to 64. These homeowners, having lost their homes during the 2008 crisis, find themselves unable to move back into home ownership as they approach retirement age. Married Black households, traditionally the most likely to own a home, lost more ground than single Black-headed households. And these trends will affect retirement prospects for African Americans and their ability to pass wealth on to the next generation. And as we deal with that, boom, here comes the pandemic and the economic crisis. The American middle class, in particular, underrepresented African Americans, entered the crisis in a financial vulnerable position. And as people have taken to saying, we are in the same storm, but we aren't all in the same boat. According to the Fed, 40% of households earning only under $40,000 per year have lost jobs since the start of the pandemic. Minority communities are overrepresented in low-wage, insecure, frontline work jobs and making it impossible for them to work from home. Those who could least afford it have been the hardest hit in terms of sickness, death, and economic impact. Preventing a health crisis from becoming a housing crisis or financial crisis is important. Now, thanks to the work we did on the Financial Services Committee with Maxine Waters and Bonnie Frank, the Dodd-Frank and Reforming Wall Street and banking sector, banks entered this latest crisis on a much stronger financial footing, and the regulators in the Fed had a playbook and systems to respond quickly in a coordinated manner. But the longer this crisis drags on, the greater the risk that the health crisis becomes a housing crisis or triggers a financial crisis. So we in Congress, particularly on the Financial Services Committee, are working hard to ensure continued equal access to fair and non-abusive banking and financial services. We're working hard to ensure the inclusion of minority banks and CDFIs in the national response as they reach underbanked communities and communities of color. Congress and the regulators have given the banks the tools and flexibility they need to work with homeowners to restructure mortgages where needed and ensure homeowners are not foreclosed upon as happened during the 2008 housing crisis. We are passing legislation to provide financial support to impacted homeowners and renters to avoid a collapse in the housing market through no fault of the impacted communities. And we seek to create voucher programs to assist impacted homeowners in making included more. Okay, didn't cut me off this time, they called me again. Mortgage, utilities, insurance, and even property taxes. The program will be a needs-based and cost-adjusted to reflect the realities of the local housing markets. And we have learned many important lessons since the financial and housing crises and intend to act to avoid and repeat the devastation of 2008. And I gotta tell you that on the Financial Services Committee with Chairwoman Maxine Waters and all of the subcommittee chairs, Al Green on Oversight, with Congresswoman Beatty, who's doing making sure diversity and inclusion, Clay, Representative Clay doing housing. We are working collectively together to try to make sure that we focus on those things that are important. And that's why we put $75 billion in the last HEROES Act to help those who may be in danger or who have lost income as a result of the virus and therefore may not be able to pay their mortgage. And $100 billion to those that are renters. And we're also focused on, and I heard my colleague, and I jumped on late, talk about CRA. And some of you might have seen that the head of the OCC, who we've had problems with, who forgets about the roots of the CRA Act being a civil rights bill. That's what CRA came out of, and never had the idea of making sure that we're putting something together to benefit, to make sure that we do not allow redlining and moving forward in that regards. That all of a sudden he retires and been pushing along, trying to put forward rules and regulations for a modernized CRA. The FDIC is not on board. The feds are not on board, setting up an unprecedented sense of madness that could take place because there's no true move forward to organize and work together so that we can make sure that CRA, given what it is today, today's reality is that we can make sure it works in better for our folks, because right now it is not. So let me end by just saying this. We look forward to continuing working with NAREB because we've got to make sure that we're creating wealth in our communities. That is the key to moving and having this, what we call the American dream. And if in fact, NAREB is what we need to empower, because what you do on a regular basis, you put people into homes and make sure they are able to stay in their homes so they can create wealth that they can pass on to their families and make a difference in their lives and in lives and their families' lives that are yet unborn. So I take my hat off to all of you at NAREB for what you do every day, working to help folks create wealth and live in their own home so that they can have a better tomorrow than their yesterday. So thank you so very much for inviting me as you begin your virtual conference. And I look forward to continuing to work with you. Hopefully doesn't look good that we will be doing our annual meeting at the Congressional Black Caucus weekend as we generally do due to the virus. But we look forward to having the opportunity to sit down with you again in person sometime in the very near future. Thank you, and may God continue to bless each and every one of you.
Thank you so very much, Congressman Meeks, and we look forward to the meeting as well. We will sit down soon. Thank you.
Look forward to it.
Thank you. Ladies and gentlemen, Realtors, I'd like to bring up at this point yet another friend to the Realtors organization. Work with her very, very closely. Very proud to call her a friend. Miss Melinda Knight. Melinda Knight is the executive director of affordable lending for the retail originations channel at JP Morgan Chase, and leads efforts to expand home ownership for customers in low and moderate income and minority communities. Melinda has her Bachelor of Arts degree from Alma College and her executive MBA from the W.P. Carey School of Business at Arizona State University. Without further ado, our friend, Melinda Knight.
Thank you so much. Good afternoon, President Williams and our distinguished panelists. I'm really happy to be here virtually with all of you today. And good morning and good afternoon to all my Realtors friends across the country. I really have a great appreciation for the meaningful dialogue we just heard regarding CRA reform and all the insights that were shared by the panelists. As you heard, the final rule was issued yesterday, so we're looking at that and evaluating those changes. But please know that we are deeply understanding of the importance and the intent of CRA, the goals of the legislation, and our obligation to serve the communities that we're in across the United States. So we're proud to continue our partnership with NAREB in your mission to help Black Americans build wealth through homeownership. And as President Williams said when he started the session, I'd also like to acknowledge the rich legacy of your organization and the impact you've had and continue to have in advocating for equal opportunity and democracy in housing. So there were some questions about the pandemic. While certainly the economic effects of the current pandemic are impacting the mortgage industry, I want to reiterate again that Chase remains committed to providing affordable lending products, programs, and services to meet the needs of low and moderate income and minority customers and communities, despite these current challenges that we all face. And we are continuing to lend in these communities. As I shared recently in your town hall, our 3% down Dreammaker product is still available for customers who are in a position to purchase, or for those needing to refinance to take advantage of the low interest rates. And that program goes to credit scores as low as 620. So we have not turned off credit to your communities, and we encourage you to work with our team to find opportunities to help your customers. We continue to offer our $2,500 Chase Homebuyer Grant and $500 Chase Homebuyer Education Benefit programs across the United States to assist customers with funds for closing costs and down payment. We know that that is one of the biggest barriers to homeownership, and we're here to help. We really want to help make dreams of homeownership a reality. We're also here for customers who need our help. For many, it may be difficult to make mortgage payments right now, but there are options available to them. So I encourage customers and your family, friends, clients who have a current loan with Chase to reach out to us at our mortgage assistance line, and we will present those options to them. Stable, sustainable homeownership is our overarching goal for every customer that we serve. I want to thank you for allowing us to be part of your NAREB family and to participate in your virtual conference today. It looks like you have a really meaty agenda, and we'll get a lot of great information to take back to your teams. Please don't hesitate to reach out to me or to one of my Chase colleagues in your market for more information about what Chase can do to help you build your business, take care of your clients, and keep your family safely in their homes. So, Mr. President, thank you again so much for having us, and enjoy the rest of your conference.
Thank you, Melinda. Thank you very much. Ladies and gentlemen, I would like to thank the staff that helps me put on. We're coming to a close for the Community Reinvestment Act session. So I would like to thank Ms. Ruby, Ms. Diane, Ms. Jill, and Mr. Ahmad for helping me conduct this so very much. I'd like to thank some of my staff, some other staff and board members for participating, for being inside the inner camp here and helping me pull this off. First, I'd like to thank my executive director, Mr. Thompson. Thank you so very much, sir. And then I have here a list of folks that are here. And I'll start off with my chairwoman, Michelle Calloway, Ashley Thomas, my third vice president, Lydia Pope, my first vice president. I have some regional vice presidents, Maya Smith, Cheryl Merritt, Bill Petrie, Terrell Walls. Then I have here, let me see here, my chief of staff, Bill Collins. I have board of director members, Courtney Jones, Lawrence Batiste, Lana Bohannon, Laura Washington, Roland Somerville. Thank you very much, folks, for being on the call. Oh, I'm sorry, I apologize. Arlene Thomas from Philadelphia for her support as well. Thank you all. I believe we're going to have a few minutes of break time, and then we're going to go into our next session. Jill, can you help me out with the time on that for the next session?
The next session is now.
Okay, I thought
we're going to go right into the next session.
Go right in. Okay, no problem. Ladies and gentlemen, we are pleased to provide our next session, and that is none other than student loans, the issue with student loans. So without further ado, not to drag this on, I'd like to bring up, I'd like to ask for a word of prayer while we bring up this session here. And this is student loan debt. I don't have a name on my report, Ms. Ruby. Who's saying the prayer for this session?
I'll pray, President Williams.
President Lydia Pope.
Yes, go ahead.
Can you unmute her?
Thank you. Thank you, Mr. President. Thank you, everyone. Father God, we just thank you this afternoon, Lord. We pray that you just open up the hearts and minds of our members and those that's on the webinar, Lord. We pray that you just instill into them the information and education. And finally, Father, we ask that you just speak to our presenters, Lord. We ask that you pour into them as they pour into us. And we thank you in advance. In Jesus' name we pray. Amen.
Amen. Thank you so very much. Now, as I said in the beginning, this first ever web policy conference is so important because we can reach more of our folks. And that way you can take this information back to your community. We know that student loan debt is a problem. Now, get this, listen very closely now. You own a home, then we know the benefits of owning a home. Number one, you live longer. Number two, you're able to start a business. Number three, you can use that home to provide for security and retirement. Number four, you can use that home to provide for education, higher education for your children. Now, when we cannot own the home, we're down to, I think the last quarter, we're at 44%. Our counterparts are 30 points higher than we are. When most of us don't own a home, then we have a problem with securing the higher education to get the better jobs. And then we run into a problem because then we run out and get what? A student loan. Then the student loan is counted against us when we try to secure a mortgage to build equity and build wealth and build generational wealth. So we need to discuss it. We need to discuss it. So without any further ado, I will call my very good friend, housed in the car chair, Letitia Grant.
Good afternoon, everyone. Good afternoon. My name is Letitia Grant, and I'm the National Chair of House in the Car. Thank you, Mr. President. I'd like to start off with the discussion talking about House in the Car. House in the Car is actually a national campaign, and House in the Car focuses on the barriers that prevent millennials from home ownership. And as we know, the car doesn't just represent the car, it represents all of the barriers. And one of those barriers is student loan debt. So welcome to panel 2 of student loan debt. I'd like to introduce our panel for today. First, I'd like to introduce Ms. Julian Joseph. Julian Joseph is the Assistant Director of Government Housing Programs with the Mortgage Bankers Association, where she focuses on FHA, VA, USDA, and appraisal policy issues. She holds a Bachelor's of Arts degree in English Literature from the University of Virginia and an MBA in Real Estate Management from Marylhurst University. With nearly 20 years of mortgage origination, counseling, and housing policy experience, Julian has built her career that's dedicated to creating safe, affordable, and sustainable home ownership opportunity for every borrower. Ladies and gentlemen, Realtors Nation, let's welcome Julian Joseph to the panel. Our next panelist is our very own Ashley Thomas. Ashley Thomas is a financial professional from Los Angeles, California. He is also a real estate and mortgage broker for First Security Investment Co., Inc. He has spent many years of hard work honoring his skills and building strong working relationships with the wider industry. Presently, he serves as third vice president for National Association of Real Estate Brokers. And he is also a proud advocate of home ownership within the underserved community and reduction of student loan debt. Realtors, let's welcome Ashley Thomas.
Thank you. Good morning.
Our final panelist is Ms. Ashley Harrington. Ashley Harrington is a federal advocacy director and senior policy counsel at the Center of Responsible Lending. Ashley provides strategic leadership and insight into federal opportunities and threats around CRL's issue areas. Ashley's portfolio includes general consumer lending issues with a particular focus on student debt. She received her BA in Public Policy Analyst from UNH Chapel Hill and her JD from New York University School of Law, and is admitted to practice law in New York. Realtors, let's welcome Ashley Harrington. Thank each of you for joining us on the panel today, and we are just going to jump right into questions and answers. Our very first question, and we're going to propose this question to the entire panel, so we're going to give each of you an opportunity to answer, and we'll start with Ashley Harrington. Ashley, why is it important to address the impact of student loan debt calculations on mortgages for Black borrowers?
Thanks so much, Letitia. I think it's really important when we just think about the severe nature of the crisis for this country in general, but for Black borrowers in particular. We are over 1.6 trillion in student debt in this country. And this is disproportionately felt by Black borrowers who are more likely to borrow more, and to take longer to pay it back, right? And we know why. We know about the historical inequities that led to this. We just heard about how how education debt builds up on the when you have lack of home equity or you don't have a mortgage to fall back on. So all of these things are interconnected, but we are really at crisis levels. When 24% of Black graduates are defaulting on their loans, and that number is only expected to grow, and that was before the COVID crisis, we know that this is holding Black borrowers back. It's stopping them from saving for a down payment. It's stopping from getting their credits in order, because if they're defaulting on their loans, that's on their credit report, right? Getting the Dti requirements to get a mortgage. So there's all number of pieces, and really these are the to be able to buy a house, right? So the college, so that they couldn't have the economic opportunity and security that comes from home ownership, but it's really shaping up to be a big barrier that's stopping them from doing so.
Right. Ashley Thomas, would you like to add to that? Thank you so much, Ashley Harrington.
Good morning or good afternoon. First, let me just say it's really great to see all the Realtist members on here today.
Absolutely.
One day we will meet again physically, but I just want to answer the question first. I want to thank Ashley for labeling this as a crisis, because that's exactly what it is. This is a crisis, and unfortunately, this has been going on in our community for some time now. And as other policies or other issues that happen, it doesn't get addressed till it flows into other communities. So now this is a nationwide concern, and we're a part of it. And I'm glad that NAREB and our president continues to push forward in making sure that we address this concern. I will say that there are a lot of us on the call are practitioners. This is what we do on a daily basis. So 10 to 15 years ago, for many of you who are in the business, as well as myself, the number one question was, do you have a car, an auto loan? Now the number one question seems to be around student loan debt and what that is. So I'm excited about the conversation that we'll have, and we'll get more into the policies as the conversation goes on. But this is definitely a topic that we have to address. Over 80% of our students have to take out student loan debt to get through this. Right. And so we don't want it. We're not against education at all, but we have to be responsible with it. And so I'm glad to be a part of the panel this morning.
Absolutely. Thank you so much, Ashley. Absolutely. We're not against education. We just want to make sure that individuals are properly planning, and we want to make sure that they understand what the outcome of student loans are. Also, I'd like to ask Julian Joseph, if you would answer that same question. And I know that we've had two people speak prior to you, so I'm going to go ahead and ask that same question once again. Why is it important to address the impact of student loan calculation on mortgages for Black borrowers?
Thank you so much, you all, and I'm so glad to be a part of this forum today. Adding to the comments that have already been provided by the other panelists, I think that it's to underscore the significance of not only just the amount of debt that's being provided to minority borrowers, but literally the repayment terms. I think that there's a huge need for more clarity around the options that are made available. And I think that there's also additional education that needs to be provided. One thing that we've, generationally, it's been presumed that advancing education will necessarily commensurate to higher earning potential as well. The anticipation of continuing education means, dollar for dollar, what I'm investing in myself in education will mean dollar for dollar what I'll be able to earn. And again, with a lot of borrowers, having postgraduate education as well, that can be extremely expensive, can lead a lot of borrowers into almost this matrix of debt that is almost insurmountable in a lot of cases. So I think when not only just taking on the debt, because it's so easy to accumulate it, but so difficult to pay it back. And I think that is very important to underscore that not only from the origination perspective of acquiring those loans, but also that the servicers of these loans are very clear and explicit in the repayment terms, how interest is actually being accumulated on these loans. And we'll get a little bit more, as both Ashleys were just saying, that we're going to discuss policy a little bit more about how different programs actually approach it from the perspective of mortgage qualification. We'll talk about that in a minute. But I think a lot of it comes from the actual application for the funding for college, and for people to be able to understand some of the fine print that's associated with it. So when they start this process of postgraduate or undergraduate education, that they're fully educated on what the repayment terms will be. Because once you've already started that ball of wax, and you're already in school and you have to continue in the debt, what are you going to do? Stop at year two and say, okay, I can't, this is too much. I didn't know that the debt was going to be this, this excessive. But by that time, it's time for you to continue to go. And by that, and you're hoping that when you graduate, that you will have, a job that will be able to support those repayment terms. So,
right.
Yes.
Right. And that is a struggle. So Julian, in kind of continuing along those same lines, in hopes of having a job that you'll be able to repay, let's talk about student loan forgiveness. I taught 6th grade math, and there was a form of student loan forgiveness within a Title I school. But what do you think about student loan forgiveness? And do you believe that could actually help potential Black borrowers?
Yes, I actually do. As you know, that there are so many programs that are available, especially if you enter into public service. After school, there can be that 10-year forgiveness that's available. But again, you know, a lot of times the career that you pursue or the first job that you have exiting college doesn't necessarily, you know, mean that that's going to be the career that you will, you know, maintain for 10 years, which leads me to say that there needs to be perhaps a little bit of modification to that current policy. I think that it should be cumulative versus continued. I think that, you know, especially given the fluidity of employment, not just in the context of COVID, but I think that understanding that graduating, a lot of young people that are entering the workforce are finding their way. And it may be, it may mean that you start, you know, in the private sector and then migrate into public service or become a teacher or a fireman or a police officer. But let's say for some reason, life takes you to a different path. And let's say that you've already invested 6 years in some type of public service, and then you transition to something else. Do you lose that 6 years of time that you've earned towards the forgiveness? And I think that that's one of the policies that need to be explored, that it would actually be cumulative instead of it having to be a 10-year sustained period of public service.
I do agree. I do agree as well. I see Ashley moving. Ashley, does that movement mean you'd like to jump in on this question as well?
Oh no, wherever you want me to jump in, or which Ashley?
Well, that was Ashley Thomas who was shaking over there in his chair.
All right, I'll let him go.
No. Well, I'll make it very quick on this one because I know we are pressed for time. I would just say that absolutely it will make a difference in terms of qualifying for a mortgage. Without that debt, we don't have anything to talk about. I think where we run into a problem, like Julian is saying, it might take 10 years for that to take place, whereas the guideline is going to look at where you are at today, right? So you have a guideline issue, and we'll talk. I want to talk a little bit more about that on the next question, but you have a guideline issue, but then you also have a debt issue. So the debt issue, we definitely want to resolve that. We shouldn't be having debt, student loan debt that outpaces a mortgage, right? 40, 50 years of your life, you're paying back a debt, and your mortgage is 30-year mortgage, right? So that's obviously a problem, and to resolve that, it's definitely going to help. So I'll leave it there for now.
Okay, I can tell you when I taught 6th grade math, I knew that there was some form of student loan forgiveness. However, it was so difficult to find the information and what I needed to do to meet those requirements. I just paid I didn't have much in student loans. I just paid them off myself. It was just too overwhelming to determine what it was that I needed to do. So in addition to the policy, I'd also say that the individuals that qualify need to have a resource of where they could go. We just did not know. Now, Ashley, since we have you here, Ashley Thomas, since we have two Ashleys, I'm going to refer to you from now on as Ashley T. So Ashley T, what is the #1 policy and or legislative fix that everyone should advocate for to address the barrier of student loan debt for prospective Black homeowners?
If that's me, okay, Ashley T, got it. Well, I'm gonna let I would like to hear Ashley Harrington to address that from the policy perspective.
Okay.
But before I want to touch on the guidelines, because from a practitioner standpoint, I think it's very important to talk about the guidelines. So a consumer applies for a mortgage, and the mortgage, how we need to consider it is, it's a snapshot of what today's actual value is on the application, right? So if a person makes $50,000 a year and they apply, that underwriter is underwriting that loan at an income of $50,000 annually. So that's a snapshot. I can't say, hey, I expect to get an increase in January 2021. I'll be at 55,000. Let's do my application at that. They'll say, no, today is where your application is at. Same thing with credit. When they do the snapshot, my credit score is what it is, and that's where they're going to do my snapshot and review my application for that. Ironically, the only thing that cannot be a snapshot in the process is a student loan. I'm on a deferment and I don't have to pay a payment. That's unacceptable. We want to factor that in. If I'm on an income-based repayment plan where I'm paying $50 a month, the guideline is saying, no, I'm going to go to a futuristic point on how we're going to review your application for qualifying. So I think what we have a great opportunity is to align the guideline and go after the guideline to make sure that it's all on the same playing field. If you're going to do a snapshot of my income, right? I'm a graduate, I have a student loan. So my earning potential over the years is going to increase. It has to. I invested the time for this specific reason to have my income increase. But you're telling me that I cannot have my income increasing be a part of today's application, but I can have my debt. And so that is a major problem. It's an idea that I believe that we can make an immediate change. Policy comes into partisan, who's in office, who's in Congress, which way that goes. But this is actually a policy that can be changed rather quickly as long as we get behind it.
Okay. So Ashley Harrington, would you like for me to repeat the question? I know it was a long question.
Oh, no, I can just jump right in.
Okay.
I agree with a lot of what my co-panelists have said, but at CRL, we actually think that we need broad-based targeted debt cancellation that's across the board, beyond PSLF, beyond IBR. We need to do something about the debt and we need to do something about it now. We have really let student debt get out of hand, right? Watched as states have disinvested in higher education at an alarming rate since the Great Recession. We have watched as the Pell Grant, which used to cover 70% of tuition at public college, now covers less than a third, right? We have watched that, and that disproportionately affects our communities as the Pell Grant goes to low-income people, right? Which we are more likely to be. So we watched that happen. We've watched wages be stagnant, even as the cost of college has gone up. So while this is happening, we've watched more people of color than ever go to college, while the costs have risen, but the grant aid has not matched that. Meanwhile, people have to go to college if they want to get a job in today's economy. All of the jobs post-recession have gone to people with some form of post-secondary education, the vast majority, right? And so we can't say on one hand, watch out for the debt and get a good job, and on the other hand, don't even take out the debt, because you have to take out the debt to get a job, because how else are you going to go to college? So because we have allowed it to balloon so much and it has such a big impact on the Black community in particular, the best way to deal with this crisis is we have to cancel some of that debt. We did a report last year with a number of civil rights orgs, including the NAACP, the Leadership Conference on Civil Rights, and the National Urban League and Unidos US, where we found that even if we did $10,000 of across-the-board cancellation, we would have an incredible impact on so many struggling borrowers, and that impact will be disproportionately felt in communities of color. So we have to do something about it, and we have to do something about it now. That we're so heartened by the fact that now, as we're dealing with the COVID pandemic, student has become a part of that story, that so many lawmakers are talking about it, because I think the recognition that this is an individual community problem, but it's also a national economy problem. If all of these folks, future home buyers, future business owners, can't do all of those things, then we all have a problem. And we definitely have a problem as we head into one of the biggest recessions we've ever had.
Gotcha.
I think we definitely have to do that. So that's the main thing, cancel some of the debt. We can talk about what amount makes sense, but some of it has to be reduced. We also advocate, to Julianne's point, changing income-based repayment. So we advocate in that same report for making one income-based repayment plan. One of the things that is a barrier for income-based repayment is that there's 5 plans. There are literally 5 income-based repayment plans. They have different terms, slightly different payment amounts. Some loans qualify, some loans don't. That makes no sense. That's confusing, not just for the borrowers, it's confusing for the servicers. It's hard to give you good advice when they don't understand all the plans, right? So we advocate for one plan that's based on 8% of discretionary income, because we think that's actually more affordable than the 10, 15, or 20% required under some of these plans, right? 8% of your discretionary income that's above 250% of the poverty line, really recognizing what the cost of living is today, right? And really looking at how we can make sure that student debt is not that much of a barrier, and that repayment is actually affordable. And then make it easier to enroll and stay enrolled, which also goes to Julianne's point. So those are the 2 big things that we think could have the biggest impact immediately on Black borrowers.
Right, perfect. Thank you so much, Ashley. And we're just going to keep you there with that same energy and move on to our next question. And that is, how do you get the United States presidential candidates to see the connection between student loan debt in Black homeownership?
Yeah, and I think that's such a good question, because they are definitely talking about student loan debt, right? And talking about home ownership, but they're not really putting it together. So I think really laying it out to them, to the points that have been made about how different agencies are dealing with debt, how they're looking at repayment, showing them there's so much research showing that, 83% of millennials who don't own a home are saying that part of that reason is because student loan debt.
That's right.
I think that's only going to get worse because of COVID, right? So many people who were struggling with student loan debt before, but weren't really caught in those delinquency and default numbers, be caught up now, because we're seeing jobs disappear that will never come back, right? So we're going to see this change even more, and we're going to feel it even more in our communities. So really showing them that connection, I think, is very important. And I think the testimonies of everyone here, all of the realtists and everyone who's in this industry who have seen things like what Ashley Thomas is talking about, where people are literally getting denied because of something that doesn't make sense and is holding them back for a debt that's going to take them 20 or 25 years to pay back. And yes, we want people to be able to get mortgages, and we want it to be affordable, and we do want to make sure that they are able to pay their mortgages over the life of the loan, but there's a better way to do that. And there are ways that are simple, which I think is also so good about what Ashley is saying, is like, some of this doesn't take congressional action, right? Like, some of this could be done tomorrow by the GSEs, by the agencies. Like, so much of this is stuff that we can do even on the margins if we want to help more Black homeowners.
Right. Perfect. Julian, would you like to add on to that? That is actually our final question.
Yes, and thank you for saying that, Ashley T and Ashley Harrington. One thing that I did want to underscore from the previous question that was asked, which kind of course, fuses with this question, some of the policy efforts that are actually in process. Ashley T brought up the calculation of student loan debt and how certain programs and agencies address it. Currently, I've been heading up an initiative at the Mortgage Bankers Association to request that FHA amend its current policy on the calculation of student loan debt. Briefly, the current policy states that for any borrower that doesn't have a monthly payment that fully amortizes the debt, they presume 1% of the outstanding balance as the monthly payment. So just for the sake of numbers, let's say you have a borrower who has $100,000 in student loan debt, is on an income-based repayment plan, and is paying $250. The fully amortized payment would be something like $620 if they were to pay it off over 25 years. Well, if that borrower is in an income-based repayment plan, FHA will not take the $250 that they're actually paying. They will presume 1%, which is $1,000 a month in their debt to income ratio. What we've proposed in a coalition letter that's been circulated throughout the industry to several trade organizations that have an investment in the housing industry, we have proposed two alternatives. The first is for FHA to align with the GSEs and VA by accepting the actual payment that's reported on the credit report. And again, as Ashley T mentioned, that the presumption should be that the only way that an income-based repayment plan will increase is if, in fact, you make more money. You're on an income-based repayment plan. So the only way that that would happen is if your earning potential increases. So that naturally would make sense. The second alternative that we've proposed in that letter that we're going to send to FHA is that they adopt the USDA's policy of reducing the 1% presumptive payment to 0.5%. And we feel like in the event that they don't accept the actual monthly payment as an option, doing the 0.5 almost marries the two options. It is conservative enough for FHA to not necessarily go on a variable payment of the income-based repayment plan, but it also isn't as high as the fully amortized payment of $620. Taking 0.5% of a $100,000 debt would be a $500 monthly payment, which would be a great compromise between what the fully amortized payment would be and what the income-based repayment plan would be. So what we're asking is either one, use the actual payment, or align with USDA, which is a 100% finance program with a smaller population in rural areas. And if USDA is comfortable doing that on 100% financing, we're hoping that FHA would be willing to do that at 96.5. So there's a joint letter that's going around in the market right now, where we have about 15 organizations. NAREB was the first to jump on board to provide their support. And we're looking forward to sending that to Deputy Secretary Montgomery in the next couple of weeks. So we have a lot of support from the industry, and we're hoping that in the interim, while we're trying to have conversations about, completely extinguishing and deleting the debt, but at least in the interim that we can help borrowers who, FHA specifically is focused on helping, that we'll at least be able to administratively have that policy taken care of and change the policy from 1% to 0.5%.
Perfect, perfect. Thank you so very much. Thank you. Ashley? Ashley T.
I got it. Thank you. I would just say that, and I'm very happy that these ideas are being placed out there and that we're moving forward.
Absolutely.
We have to continue to push through. So, in terms of what our members can do, definitely I know we'll have some follow-up on how you can continue the advocating after this call. I would just say that, this is just such a travesty, and it's so unfortunate. I think the greatest problem is, as was mentioned earlier, you have a student that goes to college freshman, sophomore year, and the debt becomes too much and they fall out. Now they don't even have the opportunity to grow that income, but they're still saddled with this debt. And so in terms of education, we have to do a better job in getting to students in high school and junior high school or whatnot, and educating on what this impact does in terms of your legacy, because we're talking wealth building and legacy, right? Mm-hmm. And then you have to look at return on investments, right? It's not, we have to take some personal responsibility as well. It's not good enough just for me to force my child to do something so I can go to church on Sunday or go to virtual church on Sunday, right? And say my child is going to this school because it gives me kudos, right? We have to be very, very intentional and have these conversations, and not just let our children go to school and take out $200,000 worth of debt on a career that's going to yield them a $40,000 annual income. We have to understand that training has to go all the way through. So, it's a travesty, and I think I'm glad we're having this conversation. This will continue, but we cannot penalize Americans, right? Because we are Americans. We cannot penalize Americans who are trying to improve their family situation by obtaining an education and riddle them with debt for the rest of their life. That can't happen.
Absolutely. Ashley, I'm so happy that you said that. As a 6th grade math teacher, one of my counterparts in our pod, because we're coupled in pods, my pod mate attended a private university to teach 6th grade. And unfortunately for her, her student loans were so high that based on the calculations, she would never have the ability to move out and own her own home. And it was actually very difficult for her to even pay a car note during that time. So we do understand that. And I want to leave our realtist with a number that was quoted by Ashley Harrington. I actually had to write that down so that I can look at how many zeros is behind these numbers. $1.6 trillion in student loan debt, $1.6 trillion. So from this, if you remember nothing else, I want you to definitely remember $1.6 trillion in student loan debt. This is a problem. This is a problem. I would like to thank all of our panelists today. Thank you so very much for the wealth of knowledge that you shared with our realtors. Thank you so much for taking out your time to express your concern about these various issues, or this one particular issue of the barrier preventing millennials and other African Americans from home ownership. My name is Letitia Grant. I am the chair of House in the Car. Thank you so very much.
Thank you.
Thank you.
Thank you. And I like to express my gratitude towards my panelists. At this time, we'd like to have Madam Chair Michelle Calloway, read off a few questions from the chat and from our Facebook Live.
Yes, thank you so much, Mr. President. Thank you, panelists. This was great. We had lots of questions and comments, but a lot of them came about the Parent Plus loans to cover tuition and expenses. Will that debt impact both the student and the parents when they are trying to both individually purchase homes?
It impacts the parent because it's for the student, but the parent actually holds it, right? It's on their credit report. So it's impacting the parents. And we have definitely major concerns because they're more likely to be taken out by low income parents, right? Because we have seen that the biggest predictor of student loan debt and how much you're gonna take and whether you're gonna take it is your income status and whether you have a Pell Grant. So this is definitely a concern, but the Parent Plus really will most impact, it's on the credit of the parent. And it's a responsibility of the parent.
So that with the Parent Plus affecting their debt to income ratio, as well is that calculated? Is that just based on the amount of the repayment, just as any other installment debt?
So
against the parent.
Sorry, I'll let the realtors talk about how I think the agencies do the calculation. But the other thing to know about Parent Plus loans is they don't have access to the same income-based repayment programs that their federal student loans have. So they don't, so the income-based repayment options are not the same. So they're not as affordable unless they were to consolidate. And even then you still don't have the same access. But I'll let Ashley and Julianne talk a little bit about how it's dealt with.
Yes, and that's correct. It basically goes back to the obligation of the person who is, in fact, the guarantor of that debt. So if the parent is the actual guarantor of the debt, then in fact, they are the ones that will be responsible for the calculation of the debt to income ratio. So in essence, yes, it wouldn't financially burden the student. However, again, it will be the financial obligation of the parent. So it will not impede on the borrower's ability to qualify because in essence, it's not their debt, it's the parents.
Thank you. I think that makes it clear to everyone else. And I think you all addressed this very well. Big concern of our realtors is talking about really having some way to reduce the debt that the student loans have on the individual trying to buy a home, as well as you all commented on legislation, hopefully that there was a way to either reduce that percentage that would be used to down to 0.5% like USDA. That is a huge concern. We had at least 10 questions about that. So just wanted to let you know that that's a need to be a part of advocating with you all on. And then the other thing, a lot of you guys really did answer it, was that we need to be involved in, we can see what all the other organizations in addition to NAREB, about with financial literacy for kids before they get to college and parents about the impact of student loans. So maybe we can have Mr. Ashley Thomas speak to that about financial literacy for both the students and the parents about the impact, and then the others can answer.
Yeah, no, absolutely. I think financial literacy is critical in terms of at what point, right? Mm-hmm. So I received my financial literacy through trial and error, right? That student loan that I bought a TV, I bought a IKEA stand that was like lopsided and about to fall over. And, I had all this student loan debt that I didn't need to take on extra. So there's times where we're taking on more debt than we really need to. So that education coming early is important. All I knew is that I went to school and, and predatory, you talk about credit cards and different things like that. It's out all the debt. It's not just the student loan. So I have access into college. I went and got my first credit card. I'm buying cheeseburgers for everybody on the credit card at 18 years old, 17 years old. I didn't know any better. So in terms of financial literacy, we definitely have to get early on in the process. Now, I will say this, I want to touch on the negative impact about credit from that it has on your credit. There's two things. One, a negative credit reporting, right? I missed a payment. Therefore, my credit is going to be impacted because I missed that payment. But there's also a negative impact. If I borrow $20,000 and now that installment loan, because I'm on deferments, is $26,000, the algorithm that the system uses looks as though my debt is increasing on a contractual agreement that it should be decreasing. So it's going to have its impact in my score. It might not say it on that actual line item on the report that you are negative, but my score will reflect that, right? And so that's the thing that, and there's all these conversations saying that's true, that's not true. I know it to be because we've ran certain reports and saw that if they paid it down under the original amount, their score would increase slightly or a lot. It still has an impact on it. So I just think the financial literacy piece is huge. We have to get started earlier in the process and not wait till somebody's behind.
You know, Madam Chair, as the moderator, I want to go ahead and jump in and let you know this. My motto is, if an individual can read, if a kid can read, they need financial literacy. As the local board president of Women's Council here in Houston, we were educating youth as early as 6 years old because they had the ability to understand the difference between a need and a want. And that's where financial literacy starts.
Yes. Absolutely. I want to get to two more comments before our time runs out. One of the concerns, and this is for all of our groups here, is that in the opinion of, in terms of how we as a people look at school and education, and we need to begin to look at other forms of educating our young people, and that it's not always necessarily traditional college as the only way, because small businesses, Black entrepreneurship has accelerated over the years, but is mostly with women at the helm. So we need to look at, while we're doing financial literacy, but as well revisiting what education looks like. And so that's something that they would like us to look at and consider taking up in terms of when we look at advocacy. And the second piece that they would like us to take and look up is, what about advocating for lower tuition? So while we're advocating for managing the student loans differently and how it's calculated, but the reason for that in the first place is because of the high tuitions, and that we need to look at that on our platform as well. And I'm just bringing this to the attention of the panel for us to consider, in terms of, these are not questions, but comments of things that we need to look at that they feel will also impact overall our ability to buy homes, because at the end of the day, that's what we're talking about.
Go ahead, Ashley. Do you want to jump in? Go ahead, Ashley. Harrington.
Yeah, sorry. I would just say, I think so much of that is true. But the one thing that I worry about is that when we say encouraging students not to just go to college and look at other options, I think that's true. College is not for everybody. But I don't want us to get to the place where we're saying college is not an option because it's not affordable, and so it's not an option for our communities, right? Like, we don't want to get to a place where we are allowing the system to get so bad that they are making it so that we have to opt out, right? We should be demanding federal investment in higher education such that students can go to college debt-free. We should be demanding higher Pell Grants. We look at the cost of college. Yes, think about how your states are funding and not funding higher education, and which institutions they are funding and how they are funding them equitably or inequitably. We all saw what happened in Maryland recently, where the HBCUs won a huge lawsuit, and then that was still vetoed in terms of getting their funding up to par to make up for the fact that they had, for years, decades, been underfunded, right? So I think that is so important. I also mentioned one thing that we advocate on is really curbing the impact of for-profit colleges, which also have a disproportionate impact on the Black community because they target us and they are more expensive. Folks who go there are more likely to drop out, and then more likely to default on their loans. So definitely advocating against these predatory institutions, but also just, we want to get to the place where we have a real choice, right? Where it's not just you telling your student not to go to college because you can't afford it, because they deserve the investment just like previous generations got, like so many other communities get. And so then the ability to then say college is still not for me, or I want to go to community college, or I want to take a different path. That's fine, but I don't want it to just be because we have created a system that is so inequitable and unaffordable.
And one thing that I would like to jump in from the conversation about financial literacy, in conjunction, the sister assistance and resources from the homebuyer education and counseling perspective as well. There are two things that I want to strongly advocate for, and that I'm actually working with in some coalition efforts. One, to shore up the information transfer between the lending community and the homeownership counseling community, because things are so fluid. As we can see with COVID, policies are changing almost 2 or 3 times a day. And the one thing that we want to make sure is that the lending community is communicating effectively to the housing, counseling, and education nonprofit community to make sure that the information that they're giving to borrowers is accurate and timely. That's the first thing. And then the second thing is to underscore to borrowers the need to get this counseling and education prior to shopping for a house, because it's kind of putting, the cart before the horse if you're in a situation where you find the house first and then do that. And the reason why I say that is because a lot of this information that we're sharing here in order to determine the debt to income ratio properly, and to ensure that, the affordability piece is there, a lot of that manages expectations for the borrower and creates that level of confidence that they have ownership in the process versus going into it and surrendering a lot of that empowerment and putting the onus on the realtor and on the lender to make the best decisions for them. So I think that a lot of that financial literacy piece, as well as the homeownership education and counseling piece, creates that education pipeline that needs to not only just be the lenders pouring into the borrowers or the agent educating them, but for them to come into the process when they solicit the help of the professionals in the transaction and say, this is what I want versus what should I get? And I think when you create that level of empowerment, there's accountability and ownership, but also a level of comfortability and trust in themselves to make the best decisions when they're purchasing a home as well.
Right. Madam Chair, I want to just chime in on that as well. I think I just want to go back to my comments with regards to financial literacy. I think it's very important that we are very clear about that. We need to instill literacy into our community, but this problem isn't because we're financial illiterate, right? Let's be honest. This is a system that is in place that is going against us. So I don't want anyone to lead this conversation as though, oh, you know what? Black folks can't buy houses because we're financially illiterate. That's wrong. That should not be the narrative. And that's not true. And so what we have to do is we have to look at what the system is, how it's impacting us, so that way we can move forward. I just think that income equality is such a big topic that we have to. If I'm going to go to college, I'm going to spend my time and my money and I'm going to get a degree. I want that degree to give me the same income that my counterparts are getting in other communities. And so I can pay back my loan like they're able to pay that back, or I can buy a home in a neighborhood where all my coworkers live, but I can't because I have a student loan, so I have to live on the other side of town. So income equality is something that we have to include in the conversation as well, but it's not that we're illiterate. I just want to make sure that, we understand. We have
Absolutely.
a lot of people cannot buy homes, right? So, okay.
No, absolutely. I don't think the sentiment from the group was that we were illiterate, but that we want to do more about educating everyone on the impact of the amount of student loan debt that we're taking on, because at this time, it's still a thing. And so not to go in, if we can avoid other options and not go to college. I don't think that was the sentiment at all. It was more that let's just make sure that conversation is being had when we're playing cards with each other about what student loan impact can be. And, as you all said, let's just look at it in a very holistic way. At the same time, doing all the legislative and work that we're doing to change things. So I think going parallel. At this time, we are at 3:02, and I understand I need to stop. We had a couple of more comments and questions that we'll make sure that we get to answer these things, which as we always do, afterwards. But I'm going to turn it over to the president so that we're ahead. And I want to thank you, panelists, for entertaining these questions that were impromptu. Thank you so much. Thank you to our moderator, Letitia. You can take it back, and the president.
Thank you very much, Madam Chair. I appreciate it. Is Madam Gaskin on the phone, Jill?
I sure am. Hello, how are you?
Okay, how are you? I didn't see you there.
I am doing well. I just turned it on because yes.
Okay. Well, I'm glad to have you. Glad to hear you and see you soon. But Realtist members, friends, and invited guests, please allow me to introduce Joanne Gaskin. Ms. Gaskin oversees the FICO scores regulatory practice and is responsible for the strategic direction of FICO's analytic solutions and partnerships serving the mortgage industry and capital market space. In her role, Ms. Gaskin works globally in partnership with financial institutions and regulatory agencies to support making better decisions to drive growth, profitability, and customer satisfaction. I met her a few months ago. I'm very happy that she's here with us today. Ms. Gaskin, thank you.
Well, thank you so much. I am so pleased to be able to participate, in the NAREB Public Policy 2020 virtual event with you. And I agree that I do hope that we can be together again soon. I would like to take a moment, Donnell, to thank you as the president of NAREB and Antoine, executive director, for your leadership in promoting homeownership and the partnership with FICO. We are working diligently to address financial literacy. It's just one method or tactic to help address the minority homeownership gap. We do know that there's many obstacles, but we are of a firm belief that an educated consumer is an empowered consumer and have invested a lot of time and energy in this direction. We do believe as an organization, we have a corporate responsibility to help consumers navigate a really complex financial system and understand how to build credit in a safe and sound manner. I think our respective missions are very much in sync. FICO is incredibly pleased to sponsor this event, which brings together members of Congress, recognized industry experts to speak to the many varied approaches to supporting homeownership growth and some of the obstacles that need to be tackled as well. So I'd love just to take a few minutes to share with you just a bit of history and some of the initiatives that we have underway at FICO and areas of collaboration with the great team at NAREB. So for those of you who are too young to remember, it was over 30 years ago that FICO brought to market the first broad-based credit scoring model, which transformed how credit was granted. The history of the organization goes back even further to 1956, when Bill Fair, who was an engineer, and Earl Isaac, a mathematician, met at Stanford. And they had really what I would consider to be an audacious idea at that time. They decided that they could transform judgmental credit underwriting to one based upon science and predictive analytics. So with a borrowed computer and $800 to their name, they decided to embark on a radical idea. They started Fair Isaac in 1956. And my goodness, have we come a long way since then to cloud computing and all other sorts of interesting initiatives. But I'd like to turn now to talking about a huge area of interest to FICO, and I believe all of you participating in this event, which is consumer inclusion and empowerment initiatives that we have underway. In 2014, in an effort to support consumer credit education, we introduced a program that we refer to as the FICO Score Open Access Program. And if we were in person today, I normally would ask you to raise your hand if you're getting your FICO score for free from your financial institution, because that would be the FICO Score Open Access Program. In 2018, actually, we were gratified by the really widespread support that we were able to announce a milestone of over 300 million consumer accounts getting access to their FICO score for free through their financial institutions. And we have over 200 financial institutions supporting this program today from the country's largest banks, card issuers, credit unions, mortgage servicers, and student loan servicers. And the neat part of this program is that consumers can see the same scores that are used by their lenders for credit decisions and the factors that affect them. So what we found it to be is really an invaluable tool to not only educate consumers, help them understand their financial health, but create transparency between the lender and the consumer. No lender wants the consumer to be confused, and the consumer wants to understand, will I qualify for a different credit products and under what terms? And so we think it creates this wonderful transparency. Most of the institutions deliver the scores through mobile apps, online, and some on paper statements. So I do hope that many of you are able to receive your FICO score for free through this methodology. And following the introduction of open access, we introduced a program that's quite similar in nature, and it's designed to support 501c3 nonprofit credit counseling firms so that they can share FICO scores and credit educator, provide this information to consumers who've reached out to assistance for financial planning. At this point, we have over 200 credit counseling partners across the nation that are equipped with the information to support consumers to meet their financial goals and are seeking to develop further partnerships in this area. So in today's tough climate, we believe that these not-for-profit credit counselors are providing a much needed assistance to consumers, and we're really applauding the tremendous value that they deliver. We know today that they are working with consumers to help them with outreach to their lenders, and we think that that is incredibly important.
Is it?
Thanks. Nope, sorry.
No, I was going to say thank you.
Oh, you're very welcome. So, well, knowing that we could do even more, last year I developed and rolled out a program that we refer to as Score a Better Future. It's a national program that brings together consumer advocates, credit educators, and community leaders in a series of free educational events. The idea is to help Americans learn about their credit scores, what financial tools are available to help them achieve their financial dreams. And we've been delighted to have many wonderful partners supporting this program, including NAREB. So to date, we've had thousands of consumers meeting with financial coaches following these events that we're holding so that they can gain access to their credit report, their FICO score, and get a customized plan to help them meet their financial goals. We've shifted the program recently to a virtual event format, given the situation we're in. But I do hope to return to delivering the program in person sometime soon. The personal stories that we hear of consumers achieving their goals is really gratifying. And I know that a lot of you spend time doing this. And so you probably reflect on the same type of emotion when you've been able to help someone meet their financial goals. So one of the things I also wanted to share with you is that we're really pleased to help support and promote NAREB's innovative House in the Car program. As I understand, these events are designed to assist Gen Xers and millennials to prepare for home ownership and real estate investment. They're working really hard to make accessible the key aspects of the mortgage transaction, demystify the process. It's scary the first time you go through it. I'm certain as the rest of you are, the first time I sat down at closing and said, how much am I going to pay for this house? If I have this 30-year loan, it's scary. And so we do need to make certain that this feels more comfortable and we help more consumers prepare themselves for being home purchase ready. So I just want to applaud the important work that President Williams and Executive Director Thompson have taken for their efforts to make homeownership accessible for all. So again, thank you for allowing me the opportunity to just join you today for this tremendous event. And I look forward to our continued partnership and all the great work that the realists are doing. So thank you for allowing me to have part of your time together today.
Thank you. Thank you. I sincerely appreciate all that you do, and working with you has been a pleasure. Ladies and gentlemen, at this time, I'd like to yet again acknowledge my staff for their hard work and diligence in helping me put this on. That would be Jill, Ruby, Diane, and Amon, along with our Executive Director, Antoine Thompson. I'd like to thank a few people who are on the call from our Board of Directors, which is very important. I have here Ashley Thomas. I have my chair, Michelle Calloway. I have Lydia Pope, Courtney Rose, Maya Smith, Cheryl Merritt, Bill Petrie, Bill Collins, Sharita McCrae, Courtney Jones, Lawrence Batiste, Arlene Thomas, Laura Washington, Kenny Morrison, Andrea Cookson. Thank you all so very, very much. We said in the beginning when we first opened up that we wanted to answer the question, what did you do? What did you do? You got a bunch of information here today so far, but 20 years, 15 years from now, 40 years from now, what did you do? Now, we know what those folks did back in 1960s and whatnot, and the fair housing laws and the marching and the dogs and the water hose, whatnot. We know what they did. It's well documented. But what did you do in the face of this crisis? Join NAREB. That's the first step. So at this time, I'd like to proceed very quickly into our third panel for the day, which is key homeownership legislation and housing finance reform. And without further ado, everyone being welcome, I would like to have a prayer for this session. Is Bill Collins online?
President Williams?
Yes.
We do have your closeout for the
Oh, it is up.
Yes.
Beautiful, beautiful. Thank you. I wasn't sure. Okay, ladies and gentlemen, as we proceed to impact lives, we have developed a new campaign, a new initiative that falls underneath the 2 Million and 5 banner that we've been pushing at NAREB. And that is housethenthecar.com. Too many of our folks here buy the car first and don't get the house. It hinders their mortgage applications and things like that. So we designed housethenthecar.com with a bunch of information. You have a FICO estimator, you have down payment assistance, you got an online fillable budget, you got your next Monday, you'll have a mortgage piece to qualify for a mortgage on there. You have your pre-purchase online class, housing counseling class, all right, that you can take at your leisure, housethenthecar.com. Just about every day we're doing a segment on our social media. And this, for the first time ever, breaking news, you will see our commercial as we enter into Realtors Nation TV. There you go. Turn the volume up.
Did you know that the National Association of Real Estate Brokers, NAREB, has been around since 1947, working hard in the background, fighting the good to ensure democracy and housing for all African Americans? And why would we stop now when there's still so much work to be done? According to the Urban Institute, only 37% of 25 to 34-year-olds owned homes in 2015. Due to financial challenges, student loans, credit card debt, and the inability to save for a down payment. We can help. NAREB is standing in the gap. That's why we must help you understand the importance of the house, then the car. 1.7 million millennials have purchasing power, but have chosen not to purchase. No more. Let's compare. A car depreciates. A house appreciates into cash. It is time. Go to the website, fill out an online fillable budget, contact one of our ambassadors. We're here to help you with tools and resources to point you in the right direction. You have nothing to fear but fear itself. Start your process to your new home. The house, then the car. The house, then the car.com.
My name is Donnell Williams. I am president of the National Association of Real Estate Brokers, and I approve this message.
So the audio, that was good, right? The audio was a little bad, but you'll start to see it all over social media. This is our program. This is ours. So we need to promote it. You need to take the class, become an ambassador. There's 1.7 million of them out there, Ms. Davey. So we will move forward in that direction. Thank you all so very much. Now, proceeding aggressively into key homeowners, our third and final session of the day, which is key homeownership legislation and housing finance reform. Is Bill Collins on the phone to give me a prayer for this session?
I am, sir. I am.
Thank you.
Join me in prayer. Bountiful God, we give you thanks that you have refreshed us by granting us the presence of Christ. Strengthen our faith, increase our love for one another, and send us forth into the world in courage and peace, rejoicing in the power of the Holy Spirit. Amen.
Amen. Amen. Thank you so very much. At this time, ladies and gentlemen, it gives me great pleasure to introduce my executive director, my own personal politician, Mr. Antoine Thompson. Mr. Thompson.
Let me say good afternoon to everyone. Thank you for being on this first virtual policy conference. We are so excited to see our folks on Facebook and Instagram and right here on Zoom. Today, we have a very important continuation of this conversation about what can we do to grow the rate of Black home ownership. Presently, the Black home ownership rate, according to the US Census, is 44% compared to 73% for white America. And so we have a lot of work to do. And then we put in the context of since last June 30th of 2019, the Black homeownership rate went from about 40.6% and it moved up to 44%. But in this COVID environment, will it go backwards? Will we fight to work hard to make sure it continues to go upwards? So we have a power-packed panel of experts who will give you some insight, some thoughts about what we need to do to continue to create new Black homeowners across the country. We will also be joined at some point during this panel for some brief remarks from Congressman Al Green. I want to introduce our panelists. Our first person is Chrissy Johnson. Chrissy is I'm sorry. Did you just put them up there? Our first panelist is Chrissy Johnson, and she is the Vice President of Federal Policy and External Affairs, responsible for coordinating the Quicken Loans and the family of companies positioned on critical housing finance and fintech federal policy issues. In this capacity, she leads all third-party stakeholder outreach efforts, including trade associations. She earned her bachelor's degree in public relations and Spanish from the University of St. Thomas in St. Paul, Minneapolis, and also graduated in graduate studies in counseling and student development at the University of Iowa in Iowa City. The next one is Christopher Vincent. Christopher Vincent works at Habitat for Humanity, office in Washington, D.C. He's a member of Habitat's senior leadership team and responsible for advocacy efforts directed at influencing U.S. state and local policy. And he is a graduate of the University of South Carolina at Chapel Hill. The next one, who is no stranger to the association as well, is Alana McCargo, is Vice President for Housing Finance Policy at the Urban Institute, where she provides leadership on the development of major programming and strategic bodies of work for housing finance, the Housing Finance Policy Center, including the cultivation of partnerships with the urban and other urban organizations, trade groups, and external stakeholders. She has over 20 years of experience in housing finance, policy, and financial services, and holds a BA in communications from the University of Houston and an MBA from the University of Maryland. Dwight Alexander. Mr. Alexander is the Senior Vice President of Industry Outreach for the Federal Home Loan Bank of San Francisco. He is responsible for representing the bank before Congress, the White House, Treasury, and bank regulators. He holds a law degree from Syracuse University, a master's degree of public administration and finance from the Syracuse University Maxwell School of Citizenship, and is a graduate of Carleton College, where he received a BA degree in political science. We also are joined by Stockton Williams. Stockton Williams is Executive Director of the National Council of State Housing Finance Agencies and leads a wide-ranging efforts to advocate and strengthen the central role of state housing finance agencies in the nation's housing system. He held senior leadership positions in the private, public, and nonprofit sectors. He has been an advisor to local communities across the country and an author of original research and a commentator on various media networks related to real estate and economic development issues. And our last panelist is Kamani Little. He is the Government Relations Officer for the Federal Home Loan Bank of New York. He brings to this role nearly 2 decades of public service experience in the intersection of housing and banking. He's a graduate of Tulane University Law School and the Walsh School of Foreign Service at George Washington University. Prior to law school, he worked domestically and internationally as a civilian analyst for the U.S. Department of Defense. All right, well, we're going to get right into it. We're on a tight schedule, but I want to thank our distinguished group of folks that are on the call. First question I want to talk about is to all of the panelists. Well, I'm going to call on only a few at a time. I'd like to ask a number of things has happened this week. A lot of big things happened this week. I want to get right into it. I want to ask Alana McCargo from the Urban Institute, what do you think the impact of COVID-19 is going to have on Black home ownership?
Antoine, thank you. I hope you all can hear me. Good afternoon, everyone. It is great to be with you, and I really appreciate NAREB for having this virtual conference and inviting the Urban Institute to speak. I appreciate this first question, and I know we have a lot of folks to get through, but I want to just say that the implications of the COVID-19 pandemic on the Black community are vast. Not only as a public health crisis and the health of our community, but also as an economic disaster that it could potentially be for communities of color for a number of reasons that we'll talk about today. We've been really focused at the Urban Institute on pulling together data and analysis to really help inform the policy actions that are being taken on Capitol Hill and by the agencies on the housing front, because of the deep concerns we have, knowing what we learned from the last recession about the impact to the Black community, the loss of home equity, the loss of housing altogether, and ensuring that as people face this financial stress through job loss and massive unemployment numbers that we have been seeing reported week over week, that there is real focus on understanding who are in those unemployment numbers, who is experiencing that financial stress. And we are seeing that young renters of color, Hispanic homeowners in particular, the industries that are really getting hit the hardest tend to be those that employ people of color. And we are very concerned about the kind of growing, inability for people to be able to make the rent, make their mortgage payments, and the implications of that long term. The good news is the CARES Act has put in some safety net, has put some stops on evictions and foreclosures, but that's all for a period of time. This is going to be a prolonged event and a prolonged economic situation for a lot of people. And so we are really staying diligent and focused on ensuring that the servicing system is healthy, the housing finance system is in a position to help ensure that there are products and programs available to people of color to ensure that they can keep their homes, and also just ensure when these moratoriums are lifted on rent and on evictions and foreclosures that folks are not left behind and end up on the streets. So I'll let others jump in.
Thank you.
But those are some of the highlights.
Thank you. I want to give Chrissy from Quicken Loans, and then I'll go right over to Kamani Little and Dwight Alexander from the Federal Home Loan Bank. Right now, you got two things that are really concerning around, and we don't want to get your impact on how it's going to impact Black home ownership. One, the GSEs, FHFA just announced some capitalization items that are supposed to lead towards releasing Fannie Mae and Freddie Mac from conservatorship. What's your thoughts on that? And then let's also talk about COVID-19. The credit box is tightening. The underwriting requirements are tightening. I'd like to, if all three of you can give some feedback on the impact of these credit tightening on Black homeownership, and will Fannie and Freddie hopefully come out of release, but this capitalization issue, some people are concerned about the capitalization requirements. If you could talk about those things.
Sure. Thanks, Antoine, and happy to be here. Thanks to NAREB for inviting us again. You mentioned the GSEs and Director Calabria's recent announcement that indicates that he is moving forward as planned with moving the GSEs out of conservatorship. And that actually has a pretty direct link, if you think about it, depending at what speed this movement goes with the access to credit and the narrow credit box, because of what we have previously focused on a lot in these panels, which is the qualified mortgage patch. So I know it's been a minute since we have talked about the QM patch, so just a quick reminder of what it is and what the status is. But the QM patch is, it's currently in place, set to expire, sunset in January 2021, which is going to happen pretty quickly, especially in COVID time. Time seems to fly now. And that would, if it does expire, currently with the patch, any loans sold to Fannie and Freddie allow you to, using their underwriting guides, allow you to overcome some of the qualified mortgage rules, which is like the 43% DTI cap, some of the Appendix Q's issues that affect gig economy workers, and so on and so forth. We came together as a coalition last year. It was actually September of last year, so that will coming up on a year soon. The coalition involved NAREB was one of the members on this, and other leading consumer advocates, civil rights organizations, industry members, including all the major lenders and their trade groups, calling for reforms to the qualified mortgage rule that would preserve access to sustainable mortgages for the creditworthy borrowers who currently benefit from the QM patch. So the coalition called for the CFPB, the Consumer Financial Protection Bureau, to do a few things, which were eliminate from the general QM category the debt to income ratio requirement and Appendix Q that I mentioned. So that's that 43% DTI just as a standalone. DTI is 43%, or DTI is still calculated in the ability to repay rules, just that one cap that really leaves people out would be eliminated. Maintain and enhance the existing ATR ability to repay requirements and regulatory language, and maintain the existing QM statutory safe product restrictions. So that's like no terms over 30 years, no negative amortization, no interest loan only payments, things like that. The CFPB is planning to move forward with this rule, hopefully within the next month or so, with a proposed rule. And this has really direct implications on the Black community, especially in this time when we're facing issues about debt to income and what that means when people don't have jobs. We're trying to figure things out, what our long-term economic well-being is going to look like. The 43% cap disproportionately affected communities of color, which is a big reason why we propose to take it out, and we think that we need to move forward with that plan. Why I mention it in regards to the GSE reform conversation is because if the GSEs move out of conservatorship, well, I said that January 2021 date is when they come, when the GSE patch expires. If the GSEs come out of conservatorship earlier, then the patch will expire. So any conversations that we're having right now around the GSE patch solutions, around pricing solutions using the average prime offer rate, things like that, whether it's 150 or 200 over APOR, I think that these all are inextricably linked conversations, especially in this environment when people are really strapped and trying to make ends meet. And we need to think immediately right now in helping this current need, and also what it means like 6 months, a year, years down the road when people try and get out of this, and we're not trapping these communities in this regressive cycle again, and there's a place to build wealth through homeownership.
Thank you, thank you. I want to go to Dwight Alexander, followed by Kamani Little, then we go to our next question.
Yeah, so I want to take a little bit different angle. I think looking at the proposal that came out from the FHFA yesterday it really showed that there is a real focus on capital and capital formation within those entities, and to really make sure that they're around in a counter-cyclical way, in a way that they continue to work when we're having economic downturns and what we're having now. It's very interesting because we don't know what this is all going to look like. You know, we're just starting to see just a little bit of the effects of forbearances and people missing payments and those things, and what will inevitably be a collapse of sort of commercial real estate and other things. And so this is going to be a long, drawn out process. We're not at the bottom yet. We haven't seen it. We don't know what it's going to look like. And so the focus on capital within the GSEs, I think, is important. It remains to be seen whether at the capital levels that the FHFA is proposing for Fannie and Freddie, whether they'll be able to attract significant enough capital, whether the return on equity for those people who invest in it will be there. It's unclear about that. As far as the federal home loan banks, one of the things the federal home loan banks did was, after they finished paying off their F-Corp obligation, they started putting 20% into retained earnings and continue to build that retained earnings pool, which has kind of set them up in a place where they have lots of capital and they continue to have capital so that they can make it through the downturn. And so I think sort of protection of that capital base at the home loan banks, protection of the capital base, and what's going to happen with Fannie and Freddie will be important in getting us through this crisis, because as much as people say we don't want the government, we don't want the GSEs to be the major players in housing, in the housing sector, well, that's what it's going to be. That's what we're going to have, for the foreseeable future, because of the place where we find ourselves because of this crisis.
All right, great. We want to go to Kamani. So we got the Congressman is going to be on in about 17 minutes or so. So we got to kind of move along.
No, thank you so much for the question, Antoine. And to sort of piggyback on what Chrissy and Dwight just said, I think it's also important to realize there's both an administrative and regulatory aspect of this, as well as a potential legislative aspect. And of course, we've heard the director has been very clear in sort of what his timeline hopes to be on GSE reform. He says he's looking at moving Fannie and Freddie out of conservatorship, sort of in the next 2 years. And as Dwight mentioned, this capital goal of raising around $240 billion is going to be very aggressive and hopeful capital goal. I mean, right now they've got about 24 billion in capital, so it's a big lift to go from 24 billion to 240. But as you look at sort of the pace and timeline of GSE reform, the directors put out some sort of clear benchmarks, and he's already negotiated with Treasury to be able to sort of hold capital. He just announced yesterday sort of like what his capital target will be. The GSEs are also moving towards hiring financial planners that will help them along this process. And also, the director has given some indications that he wants to shrink the GSE's footprint and maybe provide some other opportunities for private sector players. So as Dwight said, we're kind of at the beginning of this. And as we kind of move further down the process, we'll see what happens on the regulatory side. And I'll just jump in real quick. I'm sorry, go ahead, sorry.
Okay.
I was going to say, on the legislative side, some of the policy issues, that you've identified, that if the regulators don't move into that space, there will be an opportunity for legislators to identify certain policies that they'd like to see in what a reformed housing finance system looks like. So I think there's certainly an opportunity for Congress, when they make the determination to move forward on housing finance reform, to ensure that certain policies are adopted so that we can make sure that there's access to credit for potential home buyers at all economic levels, and also at different sort of credit levels as well. So, I mean, there will be I won't say a couple bites at this apple, but there's both a legislative path and a regulatory path, and there's hope to see some of these policies enacted on both those paths. And I'll turn it back to you, Antoine.
So one of the things that the association has been pushing for a few years has been about loan level price adjustments, the overlays that are put on mortgages, what they so-called risk-based pricing. And hopefully that with the housing finance reform, and as it heats up now that even more, hopefully we can address some of those issues. I'd like to get just 30 seconds out of Alana before I go to the next question. If you can give some feedback, and Stockton Williams, if you can give a quick sound bite as well on loan level price adjustments. Alana?
Sure. So yes, I will just say that the system is under stress, and everybody is at the moment kind of looking to figure out the best ways to manage their risk. And we saw this in the last crisis. What that led to was the instability in the servicing system led to originators and warehouse lenders and others contracting credit. And we're already seeing, as a result of this crisis, which is very different. I mean, we don't have the time to talk about all the differences between this and the last and the Great Recession, but we are already starting to see credit tighten. And we've already seen pricing adjustments be put in, risk-based pricing schemes go into place in a number of different parts of the system. And this obviously has direct implications for people that are looking to purchase and refinance, and has disproportionate implications for people of color. We've seen contractions. I'll give you just a couple of examples where credit score requirements from the lenders have gone up from, say, 680 to 700 or 700 to 720. So your minimum qualifying score has gone up. Your down payment amounts that you can put down have gone up. So some of the low down payment programs have contracted. We've also seen, and it's very important, especially when you're looking at Black and Hispanic access to credit, a lot of tightening and contraction completely out of the FHA market, which is a huge concern. And that has a lot to do with some of the non-banks who've been doing the FHA, originating the lion's share of it, having some liquidity concerns that may or may not materialize, but having and ensuring that we have liquidity flowing in the system is having a direct impact on consumers' ability to get a first mortgage loan as well as refinance. And those are two areas that we are, really kind of monitoring and trying to ensure we shore up through this crisis.
Stockton.
Thank you, Antoine. And just want everybody on the phone who's a realtist or a member of NAREB to know, if you don't already, what an incredible job Antoine does running your organization and representing you in Washington, D.C. He has been a real friend and, frankly, a resource to the state housing finance agencies in helping our members understand more opportunities to partner with realtists, and has been a frequent participant at our board meetings and national conferences. So, Antoine, I'm glad to have the opportunity to return the favor on the loan level price adjustments, the risk-based pricing, all these mortgage finance terms that probably make most normal people's eyes glaze over. Bottom line is, we've seen over the years that they make it disproportionately harder for families of color to achieve the American dream. And it's significant that historically FHA, the Federal Housing Administration, which has been more flexible in looking at risk and in reaching out to lenders to serve borrowers of color, have done a better job of it than the conventional system. And that includes the GSEs, Fannie and Freddie. Our real concern is that while you will hear over and over that this is a proposed capital rule, this will take many months, this will engender public comment, the companies are already moving to reflect the drive towards less risk, a smaller footprint that is implied in not only this new version, but the precursor. So the work really has begun and needs to accelerate, as you said, Antoine, to push back as hard as possible on a way of looking at mortgage finance that's solely or primarily about risk to these entities, that seems to sometimes leave out the fact that their congressional charters also require them to do more for certain segments of the market, even if it means the less profitable business. I think in recent years, we've been discouraged that Fannie and Freddie seem to have, if not forgotten that, remembered it a lot less often than they used to and should.
I want to go to Dwight, Alana, and Chris. One of the things that's really important is the issue of down payment assistance. Dwight, I want to thank you. You have been working tirelessly. We think we finally got a Republican co-sponsor of the bill on the American Dream Down Payment Savings Plan. And so can you all, anyone that wants to jump in, we'll start with Dwight and Alana about, and Chris about the importance of down payment assistance. I know the Federal Home Loan Banks also have one, but this American Dream would allow people to save for a house the same way they save for a car. Dwight, you want to talk about the importance of that bill, but also quickly the importance of down payment assistance?
Yeah, thanks, Antoine. I think, you know, the National Association of Real Estate Brokers has been a leader in this area with the American Dream Down Payment Savings Plan, which is essentially a 529-like plan for saving for a home. Not everyone will go to college, but everyone needs a place to live. And so I think it's essential, and especially in a time like this where we're entering a very, very difficult economic cycle, allowing people to save and having a mechanism whereby people can save to buy a home is extremely important. So I want to, you know, thank NAREB for its leadership in that area and the direction that it's taking. You know, the biggest barrier, one of the big barriers to homeownership for African Americans is being able to save for a down payment. I mean, if you look at student loan burdens, you look at other things, you know, being able to set aside a little money for a down payment becomes difficult. But if that process can start when you have a child, if their birthday money is going into this plan, if there's a way that, you know, they can continue to save over time, you know, that becomes part of the fabric of how we think about, you know, home ownership, is that, you know, you can start saving for this from a very early age. So I think that's really important. And so again, I want to thank NAREB for its leadership in that area.
All right, just before we go, so Alana, if you can just go briefly, because the Congressman is on, and we want to take a brief pause to give Congressman Green a chance to speak to us. But if you can just talk on that one, and Chris, I apologize, we'll come back right after the Congressman to finish up. Thanks.
Yes, so I will just say quickly that down payment assistance was something we've been needing to improve upon for long before COVID came along, and it's continuously an issue, and probably even more so because what we know is happening right now, as I mentioned in the front end of this, is that renters are going to experience stress. People are having to use all of their savings that they may have been, you know, people are going to have to tap into those things and deplete them potentially. And that can really delay, as I always say, stressed renters are delayed homeowners. And so what that means is that down the line, we're really going to have to think about how we improve the options for down payment assistance, continue to ensure people are aware of the down payment options that are available through the state housing finance agencies, as well as many other resources that are out there. And we're going to, the emphasis on this is going to be just even greater. The need is going to be greater. And as I mentioned, low down payment programs, if they continue to be constricted and we start to see that credit contraction, I think it's really, really crucial that people have outlets, access, and awareness about the various down payment assistance programs available out there. So whether it's the American Dream down payment legislation that you all have been working so hard on, as well as just, and Hope Stockton can talk more about this too, but just the tremendous number of programs that the housing finance agencies have available, connecting people to those more directly, and more direct integration to those programs, I think is going to be just incredibly key and needs to be in focus for the future as we get through this crisis.
Yes, we want to call back up President Williams. He's going to introduce Congressman Al Green, a very good alpha man. President Williams, you want to introduce him, and we'll come back to the panel. Well,
ladies and gentlemen, realtors and invited guests, we have a very special congressman here to NAREB. Congressman Al Green knows a lot. He's very intricately and emotionally involved with the National Association of Real Estate Brokers. And it is my great pleasure to introduce Congressman Al Green, who represents the 9th Congressional District of Houston, Texas. I'm sorry, the state of Houston. He currently serves on the Financial Services Committee, as well as the Committee on Homeland Security. He attended Florida A&M University, Howard University, and Tuskegee Institute without receiving an undergraduate degree. He enrolled in Thurgood Marshall School of Law, where he earned his Juris Doctor in 1973. It is my great pleasure to introduce to you Congressman Al Green. Congressman.
Hey, thanks a lot. I greatly appreciate your very kind and warm introduction, and I know that time is of the essence, so I'll try to move as expeditiously as possible. But it's always good to be in the company of people who know Henry Arthur Callis, Eugene Kinkle Jones, Robert Hale Ogle, and need I go on? I think not. Dear friends, you were founded in 1947, the same year I was born, and one would hope that you would be out of business by now, that there would be no need for what you currently have to do. But the truth is, the need continues to exist because we have in this country been managing invidious discrimination. We have not really put forth a sincere effort to eliminate invidious discrimination. I in Congress see as a mission that of eliminating invidious discrimination, and it can be eliminated. We but only have to have the will to do it. The way to do it is readily available to us. So let me just start with one piece of legislation that could help us eliminate invidious discrimination. H.R. 166, the Fair Lending for All Act. This is a bill that we've introduced, and this bill would criminalize violations of the Equal Credit Opportunity Act. For example, if a person intentionally discriminates against you when you're trying to make a loan for your mortgage, for your home, that would be a crime. And that person could go to jail for doing this. We penalize persons in other areas for stealing money. Well, this is stealing money, but it's also stealing your future. It's stealing your dreams, your hopes, your aspirations, all of the things that will allow you to succeed as others have succeeded in this society. Unfortunately, these kinds of bills are difficult to pass in Congress. We tend to want to manage invidious discrimination rather than eliminate it. Now, having said this, I will talk about a few other things that we've done rather quickly. In H.R. 6760, the Fair Housing Further Enforcement Emergency Act of 2020, this bill authorizes $297.5 million to protect people from invidious discrimination in housing. It provides for the testing. It deals with the harassment. It deals with race-based actions and evictions. It's a very important piece of legislation. Aspects of it were in the CARES Act. It was funded for about $14 million in the CARES Act, but the bill is still pending in Congress. I'd also like to call to your attention some of the things that I've done in the area of banking. We have H.R. 6381 and 6380. H.R. 6380 insures your deposits. If you recall, when we had the downturn in 2008, there was some concern about whether your money would be there because deposits were only insured up to, at that time, I believe it was somewhere around 100,000. My memory fades in terms of what that exact number was. Well, we have extended that. We made it such that whatever you have on deposit would be insured, and that prevents a run on banks. That's very important because if people think their money isn't safe, they'll want to take it out of the bank. We tried our very best to make sure that that didn't happen. And in the bill that did pass, we had language in there similar to what our bill calls for. We have also a bill that would provide a facility for 0% interest loans to MDIs, Minority Depository Institutions. The Fed would set up this facility so that they can borrow money at 0% interest. And this is important because small banks don't have the capitalization to make the big loans. And as a result, they remain small. It's being capitalized that helps banks to lend larger amounts of money. This would help them deal with the capitalization problem that they have. And for those people who think that things like this can't be done, I assure you, I was there in 2008 when Secretary Paulson came before the Financial Services Committee. Emmanuel Cleaver was seated right next to me. He had a few pages of paper asking for $800 billion. We funded the $800 billion. And we broke all of the rules. People will say you didn't break the rules because you passed the laws. Well, we passed laws that we ordinarily would not have passed. And some people would say, in passing this, you're breaking the rules. There were people who actually said it because they fought what we were trying to do to save the economy, save the country. So Congress can do whatever it wants to do. Do not believe people when they try to give you all of the reasons why we can't do the things that we need to do to help minority depository institutions, minorities be treated fairly in housing. It can be done. It's just a question of whether we have the will to do it. We have no problems breaking the rules to make sure that the big banks are properly capitalized, make sure that the big banks don't go out of business. We even call them too big to fail so that we would have the language necessary to protect them. We can do the same thing with small depository institutions, the small banks. I will make one additional point and then I will yield the floor because, as I said, I know you have much to do. There is another bill that we had. This one is HR 6476, and it would set up a fund to fund the loans that are made under the PPP by small banks. The small banks are limited in the number of loans they can make, the amount of loans that they can make, because they have to capitalize these loans first. They have to have the liquidity to capitalize, and thereafter they are reimbursed by the Fed. Well, this would allow the Fed to directly fund them. That way they can make more loans, make more money, and grow. Our banks don't grow, small banks, simply because they are not capitalized to the extent that other banks are capitalized. I thank you so much for this opportunity to be heard. I assure you what you're doing is absolutely necessary. If we did not have you, we would have to invent you. You are a part of the fiber and fabric of what it takes to protect people who find themselves at a disadvantage simply because of the way they look, because of their heritage. And also we're finding lots of evidence of it because of who they happen to love, the fact that they have marital relationships that other people don't consider traditional. This discrimination is broad, and we have to fight it in every circumstance, because when we fight to protect others, we ultimately fight to protect ourselves. And if you have a question or two, I'll take them, but if not, I will, of course, relinquish the microphone, the floor, and let you know that I stand with you, and I hope you'll stand with me.
We will stand with you, Congressman, without a doubt. We thank you so much for your time. I'm not sure, Madam Michelle, are there any questions for the Congressman? I don't think there's anything in the chat.
Well, I would just say, Mr. President, if we will send you your staff. I see Mr. Dawson. We are pushing the American Dream Down Payment Savings Plan, which is being sponsored by Brother Congressman Gregory Meeks. We would love to have you on that bill, which will provide down payment assistance for people saving for a house the way they do for a college right now. The other thing is that—
Well, thank you. Thank you for the offer, and consider me on it. Congressman Meeks is a great congressperson. He and I have worked collaboratively on projects before. So count me as a person who will be a part of this effort. And I might also add Congresswoman Maxine Waters, who chairs the Financial Services Committee, has a history of fighting for persons who have been left out, locked out, left behind, and who, but for a champion such as Maxine Waters, would not have a champion available to help them in Congress. There are other members I would also want to compliment who are part of the Committee on Financial Services, Ms. Beatty, who deals with invidious discrimination with her committee. We have Mr. Clay, who deals with housing. I happen to be on the housing subcommittee. So I'm honored to be a part of this, and thank you. Count on me to be a co-sponsor of the legislation.
All right, one other piece of legislation where we need someone to take the lead on. We don't have a sponsor yet, but we have a there's a bill, a section in HUD called HUD Section 184 that we'd like to see amended. It provides 2% mortgage, interest rate mortgages for Native Americans, Hawaiians, and Alaskans. You know, the VA also provides no money down for veterans, given the current historic role of discrimination. We'd love to have you be our champion for expanding 2% interest rates mortgages to African Americans through HUD Section 184. If you can have your staff look at that and we can meet with them virtually or by phone, we'd love to get someone looking at amending that law to include African Americans.
I have someone on with me. She's taking copious notes. She's a lawyer. She is taking notes only because this happens to be her committee assignment. I'm not a person who believes that a certain gender should take notes. This is what she works with in the office, and she's an outstanding public servant. Tenzin, are you there?
Yes, sir.
Okay, would you kindly make yourself available so that we can peruse this legislation for the purpose of considering taking the lead with it?
Yes, we'll do.
Thank you.
All right. Is there another?
No, that's it, sir.
Hey, you guys are great. I appreciate you.
Thank you, sir. We appreciate you.
All right. Any friend of Henry Arthur Callis is a friend of mine.
All right. 06.
Okay, ladies and gentlemen, Antoine, I believe you had a few more minutes left on your with your panel.
Thank you, sir. Thank you. So we were going back to Stockton. Williams was going to talk about down payment assistance. We you know, the realtors are in over 36 states, and that down payment assistance it's like a double-edged sword at the city level and sometimes at the state level in terms of there's never enough money. So can you talk about the importance of down payment assistance, Doc, and how you see it, and how can our members better partner with state housing finance agencies across the country?
Yeah, absolutely. State housing finance agencies provided down payment assistance and low-cost mortgage financing to about 50,000 borrowers of color last year, and that number is not enough nationally or in very many, if any, of the states where we're working. So the name of the game is to generate more resources. Fortunately, the state housing finance agencies have some financial tactics at their disposal in terms of how they access the secondary market and issue bonds that enable them to fund the down payment assistance. One thing we're worried about, Antoine, is in addition to the other big policies that we've talked about today, the Federal Housing Administration, which is so critical to everything we do, is looking at its rules regarding down payment assistance. And we're concerned that some of what could be coming from them could make it harder for us and others, including FHA originators, to serve the market with down payment assistance. So that's another one to watch for.
All right, great. So next we want to get into thank you, and so I know some of our local boards, chapters work with the state housing finance agencies. We'll come back to you in a little bit. I want to go to Chris Vincent, who I can't say enough about Habitat for Humanity. I am not Jimmy Carter, but I love Habitat for Humanity. Chris, you want to talk about the importance of down payment assistance with your folks that you help put into homes all over the country. And if you can also talk about that campaign that you all have going on and how our association can link up with your campaign to promote homeownership.
Great. Well, thanks, Antoine, and thanks, NAREB. It's an honor and a privilege to be on. Certainly appreciate the conversation, especially in these tough days, and hope everybody out there is safe and healthy. And thanks for Bill for starting us off with a prayer, which I think we need a bunch of these days. So yeah, down payment assistance is extremely important. We're looking at, it's one of our top priorities in terms of trying to understand it and trying to figure out what are the best ways that we can enhance that to as many places as possible. And Stockton's certainly right that there's a lot of opportunity there at the state level, and there's ways in which we can figure out how do we inform where the best practices are, and how do we do that in the best way, so that because for our folks, it's certainly a critical piece. We do a lot on the down payment assistance side. We see there's certainly importance in housing counseling. There's certainly importance in affordable pricing. You've kind of got to mix private and public dollars, but you also have to make that down payment assistance piece work. Just to step back a little bit, talk about the campaign. A year ago, we launched Cost of Home, which was a campaign that really focused on home affordability. Habitat for Humanity for 40 years, has really been, while our programming has diversified over time, we've really kind of been very focused on low-income homeownership. And we're very proud to say that last year, over 40% of the homeowners that we served were Black homeowners. And there's actually an interesting connection with Habitat, even dating back to our founding and to the civil rights era, in the sense that it was founded in the Deep South. And basically it was founded by seeing how systemic exclusion from housing has such a negative impact on communities. And so we're really kind of tied into this issue from our founding. But the cost of home is a big problem. That's both on the rental side and the ownership side, because as Elena was talking about, if you can't afford your rent, you're going to have a hard time saving for down payment. You're going to have a hard time moving into home ownership. So we believe it's important to look at the holistic view of the housing market, including the renter side, and say, how do we make it more affordable on the renter side so that you can also save and people can move along and get into home ownership. So we launched that campaign. We've had a goal of helping 10 million households achieve home affordability over 5 years. And our network across the country has really worked to adopt that campaign and is looking for as many partners as possible. So we're very pleased to have started those conversations with you, Antoine, and look forward to having more of those deeper conversations with many of you on this call, either at the local level or at the national level. Last thing I'd say, some part of this is related to legislative issues and certainly related to COVID issues. There's a lot of connections that may not be made. There was a hearing a couple days ago about how the PPP, Paycheck Protection Program, is not actually reaching into the communities of color and even into rural communities as much as others. And so I think there's broader issues than just housing that this group's going to need to be focused on in terms of the impacts of COVID. And then I'll lastly tie in another piece of legislation that we're focused on as a response to COVID. It was in the House package that passed last week, which is Housing Assistance Fund. That would be a significant amount of money that would go to state housing finance agencies that we think would be very, very helpful in terms of helping them have flexible resources to support many of the communities that you all work in, to deal with forbearance and foreclosure prevention, which it's going to be a whole lot smarter to do that work on the front end than on the back end. And so I just wanted to mention that issue since it hadn't been brought up yet. But
yeah, we're going to get into that in a couple seconds. But thank you. The association strongly supports that $75 billion for mortgage assistance. We actually have an advocacy alert that we're doing right now, and we will be continuing to ramp up our efforts coming out of this conference to get people help before. We don't want to wait 2 or 3 years before we sound the alarm. Our president has said that we have declared war on the decline of Black homeownership. If we are helping everyone else, we need to help not just renters, but also the owners of property. We're just going to take one more question, and then we'll do some closing remarks. I wanted to give you all a chance to talk about the affordable housing goals and also the mission of HUD to promote home ownership. If everyone can get just a quick 30 seconds on one with the GSEs on the affordable housing goals. If they come out of conservatorship, does it help the affordable housing goals or does it not? And what is one thing that you think that we can get HUD to do to increase its focus on HUD, on home ownership? So if half the panel can do one half one question, the other half do the other, but quick 30-second sound bite. I want to go to Chrissy first. You want to give quick comments on that?
Sure, thanks. Yeah, so the single family affordable housing goals are absolutely fundamental to preserving access to home ownership for communities of color, also communities, people in low income, very low income, and those who reside in those areas. The affordable housing goals have played a significant role in responsibly expanding Black home ownership across the country. And while it was great to see Director Calabria authorize, it was about $500 billion for the Housing Trust Fund and Capital Magnet Fund earlier this year, it is absolutely essential that as GSE reform moves forward, that affordable housing remains a priority. So, because the reality is that whether or not Fannie and Freddie are taken out of conservatorship, however this progresses, it needs to remain fundamental. The Fannie and Freddie are going to remain fundamental to the housing finance ecosystem today, especially around issues that matter to Black home ownership, like pricing, cross-subsidization, affordability, access to credit, and data and technology.
All right, and we'll just take one more person. I got a couple questions in the chat for you all. Why don't I swing over to get one guy on this? Dwight, you want to give a quick response on the GSE question, affordable housing goals?
Yeah, I mean, affordable housing, remains an issue and continues to remain an issue, and I think, the GSE participation in that is important and plays an important role. I think there's going to be a balancing act here, and it's like, well, how in making sure that you're getting participation out of the GSEs, and also making sure that participation is done in a meaningful way and implemented in such a way that it doesn't, affect the safety and soundness. And I'm not saying one is the other. I just think it's the implementation and how the implementation gets done that makes sure that you don't have those issues. But I think it has to continue to be on the front burner. We have to continue to all be, pushing toward making sure we can close the home ownership gap.
All right, I want to go to Chris. You had a question. Can you give us a quick soundbite, quick response? You mentioned earlier about African Americans that you help every year. It says, what is the ratio of Blacks that have been Habitat has been able to help get into homes? I know you gave a number. I can't remember what the number was.
It's on average, I think about 40% of the folks that we serve on an annual basis. I'm sure it changes, but last year it was 40% are Black homeowners.
Wow. Well, we got to figure out how our members can link up with you all on that. Yeah, that's good. Good.
And, on the question of HUD and home ownership, I would just briefly say that we would strongly support them having much greater balance on that issue, but I don't have any great ideas. So that's my soundbite, unfortunately.
Okay, good. All right, I want to give our panelists one about 30-second closing comments, because we have to wrap up in 4 minutes. There's 8 of you. So why don't we start from with the ladies first, and we'll end with the gentlemen. Chrissy, you want to go first?
Yeah, I just think thank you for all the work that you do and keeping these issues at the forefront in the conversation. It's obviously more critical than ever that we're focusing on responsible access to home ownership as a way to not just keeping people, not just building wealth, but we need to keep people in their homes so they can continue to build wealth. So focusing on something that you mentioned very quickly, but I hope we can dive into at another time, is a lot happening around the forbearance and deferral programs, making sure that folks are educated on what their options are, what is best for their long-term financial well-being, whether that is a forbearance option, but also what that means, that when it's going to have to be repaid through loss mitigation options, various repayment programs, and that difference with deferrals. So there's still a long road ahead. Obviously, like I said, we're really at the base now. While we're focusing on these immediate issues, we need to continue to focus on the long-term health and well-being as well.
Great. Want to go to Alana real quick?
Sure. Thank you. Thanks to everybody for joining today and for having me and this conversation. I'll just say in my wrap up that as we were thinking about GSE reform, I think that this COVID crisis and kind of what we're experiencing in the housing market right now should have us all pause for a moment and think about the most important components of housing finance reform that are going to really lead us through and to the future. So having certainty in our housing finance system, things like, a GSE guarantee fee and the government's role in stabilizing the market, those are really critical things that we need to kind of think about and maybe take a step back and look at what we were focused on in housing finance reform before this crisis and what we should really be focusing on going forward. Programs like Duty to Serve, I know you talked about the affordable goals, but the things that we have in place right now that are helping or ensuring that these agencies are expanding their reach and reaching all communities and all people and serving and bringing liquidity to those families is critical. So I just wanted to emphasize that. And the final point I would just make is just, stability. You said it, Chrissy, keeping people in their homes. The biggest problem, we lost so much home ownership in the Black community in the last crisis. It got to the lowest levels that we have seen in over 50 years in terms of the Black home ownership rate. We cannot let a moment slip by that we're not thinking about ensuring that as people come out of this crisis, they do not all of a sudden find themselves in default, facing foreclosure at rapid rates. I think really focusing on that stability and keeping people in their homes, having solutions in place to support them is going to be very, very critical in this time of COVID. Antoine and Darnell, thank you guys so much for the invitation.
All right, thank you. We get the guys to kind of close us out real quick.
Certainly. Well, I'll jump in real quick, Antoine. Thanks so much for the opportunity. I didn't say this on the beginning, but I'm actually the son of a realtist. My father was involved at the Atlanta chapter of NAREB for 35 years, and my mother worked in affordable housing. So it was an absolute honor and pleasure to sort of be able to take part in this conversation, which is very necessary. I think my final comment would be for all the realtists that are here. As you all follow these issues, both legislative and regulatory, I think it's also really important that you all maybe push your chapters to really build relationships with some of the entities that are out there that are involved in housing. For instance, the home loan banks, we have a number of programs that help with down payment assistance and access to housing, but also we're a liquidity source for the banks and credit unions that are extending mortgages, that are extending credit opportunities to help build more houses, to help strengthen more small businesses so that you have clients who can actually go out and build homes. So I think there's some great opportunities to build some business relationships. And I would urge you all to move forward with that. So thanks again for the opportunity. It was great to be with you, and I look forward to future conversations.
All right.
So I want to jump in there. I think the one thing that is really, really critical in all of this, and especially in this crisis, is that we continue to keep the dream of home ownership alive. It's going to be under a lot of pressure to say, well, people shouldn't own homes. They can't own homes, and it's not affordable. And what we saw during the last crisis was a lot of single family homes were purchased into corporate, REITs and other things, and then rented out to people. And they're saying, well, that's a more affordable option. We still need our homes. We still need the things and the safety and the capital and the things that come from home ownership. And so I want to applaud NAREB, and I want to say all of us need to be together in making sure that home ownership stays a part of the American dream, because it really is, and it will be under pressure in this time period.
I apologize, folks, but we are out of time. We're about 20 minutes over. We may look at doing another town hall during Home Ownership Month. I do want to mention two things. One is that our 2020 federal policy agenda is on our website at nareb.com/policy-position. So you go right onto the website to see our 2020 policy positions. Additionally, Stockton, one of your members, Terry Redmond, is on from Pennsylvania HFA, so I wanted to give you a shout out. I'm going to turn it over to our 31st president, Mr. Donnell Williams, to close us out, but I want to thank our panelists as well. Mr. Williams, President Williams.
Thank you very much, Mr. Thompson. Is Lisa Haynes on the phone? Is she in the waiting room? We were waiting for her to get on, but look, I want to thank all of you for the time you spent with NAREB today. The National Association of Real Estate Brokers is determined and focused to help the lives of the underserved community. We are here as a resource. We're asking you to be involved. We're asking you all to join the group if you haven't, if you are a guest, because we need your support as well. Also tonight, there will be a special members only announcement at 7 p.m. Please check your email. There is a commercial class coming up, and that's the end of June. So I believe those are all of the announcements. I want to again thank my staff for helping me out here. That's Ms. Ruby, Ms. Diane, Ms. Jill, and Mr. Amon. I appreciate all that you guys have done for me. I want to thank my board members who are on the call, and those being who stayed here with me. I'm so glad. Mr. Ashley Thomas, Michelle Calloway, Courtney Rose, Maya Smith, Cheryl Merritt, Bill Petrie, Bill Collins, Lydia Pope, Rita McCrae, Courtney Jones, Lawrence Batiste, Arlene Thomas, Laura Washington, Kenny Morrison, and Andrea Cooksey. If we want to go far, go together. So I thank you all so very much, because as you can see, we're going far and we're going places. We're impacting lives, just like Derek, just like I said we would, Mr. Danby, just like I said we would. So you all take care and have a good night. God bless. Thank you so much. Bye-bye.